I was just sitting there thinking, reflecting that since last time we met, and thank you so much for all of you come along to these events. It's really, it's a wonderful thing to see you. And we as the fund managers love to meet the investors at events like this. And we've really missed it over the last couple of years, not being able to see you and have a chat over coffee and hear your questions, hear your thoughts. So this is a great pleasure for us really to be able to see you face to face. I was just thinking that since we last met face to face, many of us, we've had war, unfortunately. We've had pestilence. We may be about to have famine, but luckily we haven't had death. So, you know, and we're all here to enjoy meeting each other. But it's been, you know, none of those things. If you'd asked us to predict what's going to happen in the next few years, I would not have predicted any of those things happening. They've all been quite shocking, and this is a very different world that we're meeting in now to the one that we last met in at the Guildhall. And I suppose what we want to do today is just try and first of all tell you as much as we can about the portfolio in the fund. You know, this is if you like some kind of information dump. You know, we because we live with these companies all day, every day. It's easy for us to just assume that it's obvious what's going on with them, and of course it isn't. So, you know, and I should say as I'm going along, you know, I love to have questions. So anybody who wants to ask a question, just put your hand up and I'll happily respond to it. Don't feel you can't interrupt. We'll set some time aside at the end as well, just for questions. But if you want to ask something when it comes into your head, please do. So we're going to try and set out the position as much as we can of the fund, and then I think it'd also be good to have time to talk about a little bit more broadly about what's going on in the world, and give you our thoughts about, you know, how we're trying to choose companies, what we're thinking about in terms of looking for the next investments we're making, what sort of themes we want to pick up on, and of course, you know, that's always it's a very, very difficult set of questions. So to start with, let's does that work? Try this one. No. Not sure I should point this. Can we just try and get on to the next slide? No. Where do I point it? This was working brilliantly earlier on, I have to say. Here we go. Here we go. Yeah. Oh, keep going. Oh. Oh. Oh, here we go. Okay, so forgive me, it's a little bit dark, but this is the portfolio composition by market capitalization, and I think it's always quite a good way of just getting a kind of feel for what sort of maturity the companies have in the portfolio. And I should set the scene here just a little bit by saying that for many years now, our philosophy has been to invest in companies. We have to invest in them pretty early on. We're looking for what we think are companies with great growth potential, but we see every investment we make really as being something that we want to hang on to for the long term. And the way we run the portfolios, we really like to ride with companies for a long period of time and stick with them, so we get to know them very well, and we advise them where it's appropriate, or we just admire what they're doing. But you know, the idea of what we're looking for is to find companies we can run for a long time. So all of our successful investments tend to stick in the portfolio for a long period, and as they do that, hopefully they become much bigger companies. So if you like, this is in some ways of just the market capitalization figures, which feature in a few parts of this presentation. They're really, if you like, a measure of the length of that journey, and it's I think one of the great things about the VCT structure is that we are in absolutely no rush to exit companies. And you know, very, very often in the world of private company investing, investors, as soon as they've invested, they want to find a way out. There's a lot of chat about the exit. For us, we're much more focused on the long-term strategy of a business. We want the company to be managed in the long-term interests of shareholders, and you know, we kind of make it clear to investee companies that our idea is to be there for a long time, and to even though we have to invest very early, but to actually enjoy the investment when the company becomes much more mature. And of course, as companies become more mature, they become significantly less risky, they become more robust and actually more able to survive times like this. It doesn't stop the share prices going down, but actually what we're really looking at is how strong are these companies and how much can they ride the bumps that the world is going to throw in their way. So this is where we are. You can see one of the big features of where we are at the moment is we have a lot of cash. So 23% of the portfolio is in cash. That's very unusual for us. We had a prospectus offer, which many of you will know, and it filled up very quickly. And in February, we decided to use the over-allotment, if you like, to get a bit ahead of the game, get a bit more cash than we needed in the next few months, partly so that it would delay the time where we need to go through all the work of producing another prospectus, but also just so we were ready for investment opportunities that came along. And actually what's happened a little bit unpredictably for us is that, and again I'll talk more about this as we go on, but the largest qualifying investment in the portfolio, a company called IdeaGen, has got bid for, and we're expecting the bid to go through. So that's going to bring in another something like 7% of the portfolio in cash. So the cash number is going to go over 30% when that happens. And you know, we've never been in that position before, but actually, in many ways, it's quite good timing from many points of view, because it means we've got an awful lot of initiative to take in terms of finding new investments in what are much tougher market conditions. So it should be in the long run helpful. And then you can see we still have 5% of the portfolio that's over 1.5 billion market cap. You know, if you'd asked me 15 years ago, would we ever have a company over £1 billion market cap in the VCT, I would have said no. So it's a delightful surprise that some of the companies we've invested in 7 or 8 years ago have really flourished and become medium-sized, you know, very strong, interesting, world-class businesses. And another 13.4% here is over 1 billion, and then it gets progressively smaller. We have about 14% of the fund that's below 50 million market cap, and these are obviously typically going to be newer investments. Some of them may have been in a long time, but quite often the new investments we're making will be below 50 million market cap. Nearly all of them will be below 100, and you know, hopefully over time these things creep up. So I thought we'd just maybe remind ourselves of the top holdings in the fund. IdeaGen I've just talked about, it's just around 7%. That's because it's been bid for and the price has gone up. And you know, so it's kind of bucked the trend really of the markets. Most of the other holdings in the fund will have gone down in value over the past few months in the big market sell-off. So we put the share price movements here. Polarian was one that was very adversely affected last year in the last financial year by a decision from the FDA, the medicines regulator in the US, to delay an approval of their product. And I think Gareth will talk about that one later. But it's one of the things that I think, underestimated coming out of the pandemic, because the pandemic was in many ways brought healthcare stocks into such a focus, and we all remembered why we invest in healthcare stocks, because we really need these technologies. And investment appetite for healthcare really grew significantly. But then coming out of the pandemic, one of the biggest features of that has been, if you like, the regulator just kind of seizing up and not really doing anything. So it's been very noticeable in the US that very few products are being approved. The regulator has become, if you like, a little bit dysfunctional and is just pushing everything back. They have a slightly strange set of rules where their funding is dependent on issuing 90% of their judgments on time. So instead of just being late, with most of them what they do is they issue something called a CRL, a complete response letter, which just asks a whole load of other questions, and it pushes the thing out 6-12 months, and that's what happened to Polarian. I don't think that would have happened in more normal times, but it's been difficult for the company. It's just caused a delay. It's a cost, and there's not much we can do about it. And then other ones, Keyword Studios. This is an interesting company. It's in the video games arena, but it's an outsourced service provider to video games makers, and they will provide all kinds of specialist services that require global expertise. So if you're making a game, say in Germany, but you want to sell it in Japan. You need a particular set of experts in Japan to localize that game into a Japanese sort of understandable framework, as well as doing the translations. But it's more about what the backdrop should look like. How do people behave? What are the subtle nuances of difference culturally? And that's where Keywords started from, providing those services for the really large video games makers. And they've extended that into all kinds of different ways. They've carried on acquiring businesses. It's one of the few companies in its area which really has global scale. And it's one of the largest market capitalizations in the portfolio. Learning Technologies was an online learning business, and it's branched out into other kinds of software. It's had slightly less impressive journey than Keywords. It's had moments of fantastic promise, and then what it suffered from a little bit is some of the companies it's bought haven't seen the same levels of organic growth that they used to see, or that they were expecting to see. So the organic growth of some parts of the business has been lacking. But nonetheless, it's still a very strong company. It's become of significant size. It's not highly rated anymore, and you can see the market cap still around £1 billion. But it hasn't been as profitable investment for us as Keywords has, for example. And then a new entrant here amongst the largest holders is a company called Saietta. This is a very new investment. I'm not going to say very much about it because we're incredibly lucky to have Vic, who's the CEO of the company here, and he's going to tell you a lot more about it after we have a break. And I think you'll enjoy hearing about that company. And then just ticking on through the list here, Frontier Developments. Probably many of you remember this. They've been to AGMs in the past and presented their games. That's a video games manufacturer that started its life with a game called Elite Dangerous. And David Braben, who's the chief executive of the company, first wrote Elite Dangerous when he was at university in 1984 and published it as a game, set up the business in the 1990s. But it became a bit of a cult game, and it was written for I think the BBC computer, and it was a little X moving around on a screen. But it's one of the first such games that tried to simulate 3D, and it was a strategy game which was very, very unusual in those days. So when they reissued the game, the people who've been fans of it for 20 years were immediately very keen on it. So it's been a successful product. And what they've done really since that launch when we invested in them is that they've just expanded the business. So now instead of just they still have Elite Dangerous, but they also have a whole range of other games. Mostly along similar lines, they specialize in really simulation and games that are graphically very beautiful. So they have a theme park game which came out of a game called Roller Coaster Tycoon 3, and they then renamed it Planet Coaster, and that's all about you build your own theme park and you can ride it and manage it, and its attractions are kind of clear, and it already had a fan base before they wrote it. And then they came out with a game called Planet Zoo, which was first they got into zoos because Microsoft asked them to write a game before they were independent. And then the zoo game is just fabulously beautiful to watch, and it has a younger players enjoy it. It gives you a kind of close-up experience of all kinds of animals you wouldn't normally get that close to. And you can see, so that's the general trajectory, and now they've got a whole stable of games. And the thing about these video games, the way they used to be pre the digital age really was you'd spend years publishing this game, you'd get it out into the shops, and if it flopped, there was nothing more you could do. If it's successful, you just wait and do another one a few years later. Now, the reason why these are much better companies than they used to be is because these are digital assets, and they continually incrementally add to them, and so they're always selling downloadable content, which is a little extension to the game. Sometimes they give it away, sometimes if it's more significant they sell it as an add-on. So if you like, the way that the company can continue to earn money is much more incremental and steady, and to a significant degree predictable. Not completely predictable, but much more predictable than life used to be for video games developers. So we've had a very good experience with Frontier, even though it's sold off significantly from its highs. It remains, I think it's a company that in the medium term, it's got all the potential to be a world-class company, and it's very effectively run. It's grown its number of employees hugely. This is really quite a significant sized company now. GBG is an online authentication company. So when you do an online transaction, whoever you're buying from has to authenticate who you are. And that involves pretty fancy software these days, which is why it can happen very quickly. And more often than not, you have a company like GBG behind the scenes doing all those verification steps and identifying fraudulent or risky transactions. And again, that's a company that's just grown. It's a classic kind of growth company. It's just grown incrementally year after year. It's a highly competitive market, but they're one of the largest players out there now, and they've continued to acquire in order to maintain that position. And a couple more. Water intelligence. I'm just going through these because these are really the kind of the core of the portfolio, these top 10 holdings. And if you understand these, you've got a pretty good feel for how the fund is really invested and how it sits. Water intelligence actually was a surprise that it's in the top 10. It was a very tiny investment. And it's one of those ones where we liked the business, but they didn't need very much money and they weren't willing to raise very much money. But we gave them a bit anyway and thought it would always sit well below the radar. But it's been so successful actually as a company that it's gone into the top 10. I think we only invested something like £400,000 in or less in water intelligence. And that's a leak detection business. It's a franchise model in the US, and they have some operations in the UK, but it's principally in the US. And yeah, it was a national franchise, and they've been gradually acquiring some of the franchises around the country, and then that's driven quite a lot of the growth. But you know, leak detection, it's a good, steady business to be in, very profitable business. Leaks don't stop even when the economy is not great. AB Dynamics it's been again another very successful investment, but in last year or two, shares have sold off. But yeah, we remain optimistic about AB Dynamics. They're an automotive engineering company, and they specialise in testing services. So they have gearbox testing services, which are very specialised, but their high growth area was actually crash testing services, where they would provide these very sophisticated kind of dummies that would ride in the car, and then they'd drive the car on a track and crash it, and then they'd monitor everything that happens in the crash using the dummies. And the reason that was a very exciting place to be is because as the number of new models of cars have proliferated, partly driven by the move to electric vehicles, I should say, that's required a whole lot more crash testing. So that the business has really flourished over since we invested, and that was around 2013, 14. And then finally, Angle is another healthcare one, which has gone into the top 10 just recently because they managed to buck the trend of, and actually did get an FDA approval just a couple of weeks ago of their product. This was something, again, we backed this a few years ago. It's a very simple but effective device, and what it does is it's really a filtration device where you take a blood sample from a patient, you put the blood through Angle's parsortic device, it's called, but it acts like a filter, and it filters the blood cells by size, and it takes out any blood cells that are too larger than normal. And it does that because those cells that are large are the precancerous cells that float around in your bloodstream, and they're called circulating tumour cells, CTCs. And filtering them out allows you to analyse them and allows you to detect cancers way earlier and less painfully and more easily and more cheaply than many other kinds of techniques. And because this particular filtration method keeps the cells alive, you can do a lot more analysis on them. So there are other ways of doing it, but they tend to kill the cells, and then you can't get as much information out of them. So the approval is actually very important for Angle, but nonetheless, healthcare is a long journey, and Gareth will talk about this. Once you get your approval, you've then got to commercialise. So, even though it's the end of a phase for Angle, it's the beginning of another journey, but at least it opens that door properly to commercialisation. So that's where we are with the sort of the big holdings. We like to put this slide up too. This really is just looking at the geographical distribution by revenue. And, it's always sometimes a bit surprising to note that, actually the companies that we're investing in have become very international. And, one might be tempted to think, well, it's a VST, it must just all be about the UK. That's absolutely not true. And the UK is a dynamic enough economy that the successful companies here succeed around the world. And this really, showing the split by revenue, just illustrates that. So only 43% of the revenues of the companies that we're invested in come from the UK. Big chunk from North America, 26%, 16% from Europe, and 15% from the rest of the world. So, pretty broadly based international portfolio. Sorry, this is a bit hard to see against the black background, but this is the sector weightings. It's quite a simple side against the benchmark. And as you can see, the biggest anomaly is cash. So we're on the far side. Cash is very high and about to get higher. Our information technology weighting, as you'd expect, is much higher. That's going to fall, of course, with IdeaGen having been sold. And you can see we're a little bit... Yeah.
What's the red and the grey?
So the red bar, yeah, that's not really... The red bar is the weighting in the portfolio, and the grey bar is the weighting in our benchmark. And, we don't really... we are completely benchmark agnostic. We don't... it's just a guide to say that's how the market's split. We're not trying to manage the fund to the benchmark. We manage the fund by buying the best companies we can find that qualify. But this is how it splits out. So we're very underweight, for example, in industrials compared to the market, and energy and consumer staples. We're overweight healthcare and information technology. That graph is always on our fact sheets, by the way. So if you want to see it more clearly, dig out one of the fact sheets. I should say, as a little aside here, on terms of the fact sheets, we were just talking about it in the board meeting earlier, that we want to make sure everybody who wants to follow the fund's progress, by far the best way of doing it is to contact Rachel and go on the email list for the fact sheets. Then you'll get an email every time they come out, and you can see the latest commentary. This kind of information is always in there. And this is really the performance since the year end. And you can see these lines are all pointing downwards. This goes up to the end of May, and June has been another down month, I'm afraid, but that's a little bit the nature of the market we're in. The fund fell fairly heavily the first month, and a little bit less heavily compared to the benchmark. So the red line is, the blue line is the fund's NAV, the red line is the Numis index, which has been a little bit ahead, but not much. And then you can see the Numis smaller companies index, the bigger companies, and then our smaller companies fund above that. And that's just since the end of January. Really just for information. So I thought maybe we should then just talk through some of the... yes, of course, please.
Can you go back on the previous slide?
I can. I'm just going to get you the microphone so that everyone can hear the question. Well, if that's on. Oh, okay. Rachel's going to bring it. Yeah.
Thank you very much. My name is Pavel Bubak. I'm shareholder. So this is actually relating to a question I was thinking about. If you've ever done some sort of backtesting or got some sort of feel, what sort of impact does the fact the VCT regulations have where you can't effectively trade around the positions on the long-term performance? And now here we can see that, for instance, in the smaller fund, you've overperformed, and in the VCT, you've underperformed. So can I actually imply anything about the effect of this not being able to trade around from this graph?
Yeah, no, thank you for that question. It's a really good question. And yeah, the answer is we can say quite a lot about that. So I don't know if everyone heard the question, but it's really about how constrained we are, how much the rules that govern VCTs affect the performance. And I suppose what maybe a good analogy here is to make that the way the rules work, effectively they force you to get into a sports car all the time, a little bit. So, you're having to, you're making investments which are quite high risk, high reward at the point when you make them. And as you all know, the rules changed very significantly between 2016 and 18, and they really pushed VCTs a lot further in that direction. So we have to invest earlier, typically, than we used to have to. And we have to demonstrate, actually, that we're taking risk. So if an investment doesn't take risk, you're not allowed to make it from a VCT. And that didn't change anything for us. We always took risk in our investments. But the kind of things that did affect us were we can't fund companies to make any acquisitions. We can't fund companies that are more than a certain age or more than a certain level of maturity. If you like, we have to fund companies which have a demonstrable need for the cash to grow the business. So we have to be funding growth in the company. And so all those things are pretty tightly monitored, whereas before we were able to fund just a bigger set of companies, and including companies that were doing kind of roll-ups in the industry, acquisition-type vehicles. That's a thing of the past. So, you know, I think what I've been saying in all the meetings since then is when we make new investments, you know, we have to make riskier investments. That's the way the rules go, and that's really the trade-off with the tax reliefs. So, you know, the government is very tempted to think that they're sitting there thinking, well, you know, actually, we don't know if we're getting a good enough deal out of this, and they look at the industry very hard. You know, from our point of view, we think actually the deal is very fairly set between the investor and the government, the taxpayer, in terms of how much impact this kind of work we do has on the economy, and in bringing forward the next generation of companies against, and therefore the investors are taking extra risks against the benefits you get by investing in the VCT. And, you know, I personally think those two things are pretty fairly set, but you'll see that in times of, you know, very difficult markets, I would expect the VCT to suffer more than our smaller companies fund, because, you know, it's strapped into quite a lot of early stage companies, and the whole portfolio is really growth investments. You know, we can't do any real value investments in the VCT. That in the past we could make one or two that were qualifying. Really, that's not possible under the new rules. So we have to be quite forward-looking, and we have to try and make sure we get an appropriate deal when we invest, that we're not overpaying for new investments. And, you know, in the last couple of years, that's been very difficult to do because, in general, valuations just got too high on the market. And so I suppose one of the themes of today really is that we've, you know, the gas is all coming out of the market, and it's been deflating pretty rapidly, as you know. And then the big question is, how long does that go on for, and, you know, where does it settle, and where can we say, well, actually now this is looking really attractive again? And we've got some numbers on that later. Of course, I don't know the answer to that question, but I know that when we're negotiating new investments, you know, we have a different, you know, the valuation discussion is very different now to what it was even 6 months ago. Yeah, Peter.
Would part of an answer to the gentleman's question between the TB fund and the VCT fund be that in the VCT fund you can't buy shares in the market to add to a good holding, whereas in the TB fund you're free to do more or less whatever you like?
Yeah,
or is that not a significant?
100%. So yes, thank you, Peter. That's the other point to make. So we can only buy qualifying investments in this fund, apart from investing in other funds like we do the smaller companies fund itself. In terms of direct investments, we have to buy, when we're making a qualifying investment, it's always new shares in the company. So the company has to be issuing the shares, which is why we're, you know, the prices we pay for shares are negotiated. We don't buy them on the market. We're buying them in primary deals where we sit down with the company and they say they want this much, and we say, well, actually we want to pay this much, and generally we have to meet somewhere in the middle, and it depends how many other people are going to be willing to buy them at a higher price. So we have to be pretty aware of where the market is when we're making those investments. But sometimes with really great companies, we know we've only got one chance to invest. So even if we think it's a bit expensive in the short term, we'll make the investment thinking, well, in 3 years' time, if we don't have this investment, we're going to really kick ourselves. So yes, please.
I wonder whether this is part of the reason why certain holdings that used to be in the VCT, I don't know, that must have been sold, but actually the same holding is in the fund. I mean, this is, I noticed about Gear for Music, and suddenly it's not in the VCT anymore, and I don't even know at what point it has been sold, but it is in the fund, isn't it?
Let me answer that. So yeah, so what we're really asking about is the relationship between holdings in the fund and holdings in the VCT. Actually, in the case of Gear for Music, that was one of those times where we never bought it in the VCT. And it was a very good case in point, though, because I had a long argument with the broker and the company over what it should float at, what price it should float at, and I didn't want to pay the price it floated at. So we didn't buy it. But actually, that was really a mistake, because it would have been a great investment for the fund. But in the short term, I was right, because actually the shares over the first year went down, but then, of course, they did very well. So, but that's a very good illustration of the kind of view we have to take when we're making an investment. It's not really about, is the share going to go up 20% in the first 6 months? What we're really thinking is this an investment we want over the next 5 years? And is it going to generate a lot of value over that period of time? And it's just, it's quite a hard mindset to get into, but it's the one, as a VCT manager, we have to cultivate. Great, thank you for all those great questions. So these are the biggest contributors. I know I'm going to have to speed up a little bit because I'm going to run out of time shortly. But so Ideagen, you can see here, Angle had the approval. OMP is a tiny holding, but it has managed to go up a little bit in the quarter. Equals Group as a stock, if you remember that, they do prepaid debit cards, and they were really an FX business for going on holiday with one of their cards. They've now really broadened that business out, and they've moved much more into the business-to-business kind of area. So they're doing expense cards for businesses and all kinds of quite specialist services for businesses. It's actually been flourishing since the pandemic finished. And then Block Energy, again, it's a tiny holding. It's our only energy stock in the fund. It's very unusual for us to be able to have an oil company. And I'll talk a little bit more about oil companies later. This one had a very bumpy ride. It was hugely successful, and then that success kind of evaporated as the oil well they thought was so good turned out to not be very good. And it's been in the doldrums really for the last few years. Had a major row with one of its biggest shareholders. We actually were very involved in supporting the management team through that period. But actually now I have to say this company looks really well placed. And we are, one of the features of the next few years, I think it's not going to be short term, is we're in the midst of an energy crisis. And actually oil and gas companies have just a hugely important role to play in sorting that out. But that's one of the things I was going to try and talk about later on when we have a bit more time to have a bit more of a wide-ranging conversation. But nonetheless, that's why Block Energy is here. And then in terms of the fallers, I'd say a couple of things to point out here. Polarium we've talked about. LTG is this derating of software companies. Tristel had a profit downgrade, and actually it's unusual for us, but we've actually exited Tristel, even though it's quite a large, profitable company. And I suppose we just felt that we didn't see ourselves having much of a route to making a good return out of it, over the medium term. So we just took a view to realise the profits we'd made in it, and it had been a very profitable investment. But it was one of the more mature companies that we unusually sold. Diurnal hasn't been a very happy story. And yeah, it's had regulatory issues. I'll maybe let Gareth talk more about that one later on. But we've sold some of the shares in Diurnal, kept a few, but it's now a pretty insignificant position in the portfolio. It'd be lovely if it can recover and come back, but it's one that we're still going through various thought processes on. And then here, what I've tried to, and this is a very busy slide, and apologies about this, but I couldn't think of a way of, I think you can ignore all the numbers above. I just look at the red numbers, because the red numbers are the unweighted average of these numbers. So they give you the sort of snapshot of how the portfolio looks. So what we've done here is I've taken all the maturing technology companies. So these are going to be the bigger companies in the portfolio. It's about 20% of the NAV, just under 20%. And you can see here some kind of pretty conventional valuation metrics. And I've done this using Quest, which is the database that we really use to value companies the most. And Quest doesn't have every company in our portfolio, so some of the information I provided is missing one or two companies because they're not there. But here you can see something like price to sales is a metric that's looked at a lot. You can see Quest is showing a market average of 1.4. We're at 2.4. So that tells you we're more at the growth end of the market. But you can see the sales growth of these businesses on average, 34% nearly. Some of that's going to be a pandemic rebound. So if this year we're in, you do get some pretty distorted numbers from that. And you can see there's growth forecast for 2 years out as well. But that number, I'd say in the market in general, far out forecasts are not being moved that quickly because it's very hard to predict where companies are going to be in 2 years' time. You can see the price to earnings ratio, what was called the PE ratio, which is the market capitalization of the company divided by its earnings, its net earnings after tax. It's on 17.5 times, much lower than it would have been a year ago. The market as a whole is on about 16. And this market average, the way Quest would be doing this would be, it would be taking similar sectors to it's a market average for the sectors that these stocks sit in. So that's the kind of, the more growth end of the market. And then you can see there's dividend yield, 1.4%. And quite important, we look at this number, the 3-month EPS momentum. What that's showing is how's the earnings forecast for this company has changed over the last 3 months. What's the direction of travel in that? And you can see there's actually been a rise over the last 3 months overall in this portfolio of 5%. But within that, some very big moves. So, Accesso's had a big upgrade, which would have been driving that. Some of these companies have also had quite big downgrades in the past year. So, and you can see that actually, Accesso's EPS growth over the past year got hit, but this was really the pandemic effect feeding through to its earnings. So it had a big down year. It's now rebounded a bit. So I won't dwell on that. But you can see that actually these valuation metrics in general, they've really normalized. They're pretty close to their long run averages. If anything, they're on the low side. And that's really been the way the market's adjusted very quickly to the kind of conditions we're in. And very quickly, I just did the same thing for a bunch of other companies that were profitable and therefore analyzable by these metrics. And you can see these are comparable numbers, actually. And then I'm very quickly going to go through this. This is our usual bubble graph. It shows quite a lot about the evolution of the portfolio over the past decade. This is 2012. We can see no company in the portfolio was bigger than, say, 200-300 million in market cap. And the size of the bubble is the size of the holding. This is the market capitalization. That's the year of investment along the bottom. So these ones here are much older holdings. And you can see the way this has evolved. And then from 2017 onwards, actually some of these companies really made fantastic progress, became much larger. 2019, this is where we're in 2020, and you can see the names of some of these companies, keywords there, GB Group. 2021, they got even bigger. And because of the derating effect, most of these companies got a little bit smaller over the last year, just because the market is valuing them at lower levels. So that's how the portfolio's evolved. I'll just very quickly go on to talk a little bit about the qualifying investments we've been making and what we call deal flow. So how many new opportunities have we been seeing? And 2022, the year that the annual report covers, was really a bumper year in terms of making lots of new investments. Many new opportunities came along. Not too surprisingly, that's shrunk quite a bit in the first half of this year. And far fewer companies are floating, fewer companies are raising money. The market's kind of clammed up to a degree. I think, looking at our pipeline, we see a lot of things coming down the track, companies that want to raise money. The question is all about what price can they raise money at? Can they raise enough? Can they form a deal which they can live with and the market will support? Because valuations are much lower. And this slide is just to do with follow-on investments versus new companies. And the red bars, which you can just see at the top here, they just represent companies where we're investing more money into the same company. And it's a very important feature of VCTs that we can continue to support some companies as long as they don't get too big and become non-qualifying. And actually that act of re-supporting them is pretty crucial. Maybe sometimes hard for the policymakers to understand the value of that, but it's really, it allows VCTs to be much more valuable to the companies we invest in. But there were no follow-ons in the first half of the year. And that's really saying that actually most of the companies we're invested in are not going out looking for more money. And we're not expecting too many follow-on investments in the next 6 months. Maybe one or two, but not many. And this is just showing you that deal flow slide. You can see the numbers are well down in terms of the number of companies that we've been screening for new investment and the number which we've participated in. But I think the second half of the year, and certainly hope the second half of the year, will get busier. And clearly when we raised the money in February, we could see lots of companies we thought were going to come. Most of that has been delayed, but hopefully will start to come through in the second half. Great. I think that with that, I'm going to pause just for 1 minute in case there's any other questions. I think there are a couple of questions. Okay, we should maybe just take one here first of all.
What do you do with the 23.2% cash?
So yes, so what do we do with the cash we got in the portfolio? And the answer to that is we are very actively looking for new investments, and we screen really quite a lot of companies, and we try to shape deals that we want to invest in, and obviously talk to the brokers in the city. They very often give us a very early look on companies that they want to raise money for, sometimes even a year before they float, so we can see things coming down the track. And oh, sorry, where do we hold it? Well, actually, we hold the money. This is a good question. We currently hold the money with our custodian bank, because it's pretty much it's not a deposit-taking bank. It's not a lending bank. All it does is hold cash for its customers. So it's a very safe place to hold it. But actually, now interest rates are going to rise a bit. We might start looking for interest-paying deposits again, which we sort of stopped doing when interest rates were close to zero. Yeah, so I think that will feature again. It's a trade-off between, we don't want to take risk with that cash, but I think that the interest rate rises will feed through, and it will be worth our while to take some deposit-taking risk again to get paid some interest. Yeah, thank you for that. Yeah, Robert.
Paul, a related question. The IPO market is closed since the start of the war. You've got lots of cash. So you're going to have I would respectfully suggest you're going to have some difficulty investing in quoteds. Does that suggest that the direction of travel is you're going to do more pre-IPO unquoted, loan stock related investments?
It's meaning we're looking at more, but whether we end up doing more. So we have a kind of, at the moment, an agreed limit of 5% of the portfolio could be in pre-IPO companies. And the idea of that is that as we make some then float and free up space for other ones. So at the moment we have about 3.4% in unquoted companies. We could make another 1 or 2 small investments to take that to 5%, but not really beyond that. And then, we hope that actually 1 or 2 of them will float either later this year or early next year, and that will then free up space for a bit more. So yes, we have to do a little bit of work in kind of generating our own pipeline. And clearly, if we're making a pre-IPO investment, a big part of the idea of that is that then that company will float, and we can ideally invest more in it at that point, as we did with Sayeta. We made some pre-IPO investment and then invested a similar amount again at the float. And what that enables us to do is really become a much more significant shareholder in the company than we can do if a nice-looking company floats at a good price on the market. We make the assumption that every VCT is going to want it. We're probably only going to get a small amount. So part of the logic of being willing to do some investments pre-IPO is that we can then make bigger investments in companies. Great. Thank you for that. I will now hand over to Gareth.
Hi. Good afternoon, everybody. I'm going to talk to you about healthcare valuations and how they relate to some of the VCT healthcare holdings. So I thought it would be a good idea to start by looking at the current factors to take into account that are impacting healthcare valuations. So the main one of which is the valuation reset that's happened, and that's captured in this chart from the Nasdaq Biotech Index. So you can see, hopefully, just with the black background, so the start of 2020 you had a sell-off due to COVID, and then a bubbling up of the valuation, and then quite a sharp sell-off from about the middle of 2021. And so if you looked across any healthcare index, you'd see broadly the same pattern of sell-off. And that's been indiscriminate. But what it does mean is that valuations have come down. And then in combination with that, you have the funding backdrop. So Paul's already touched on the public sector funding drought that we're experiencing. But I think importantly, the industry chatter is that private early stage rounds are still pretty robust. So that does bode well for future VCT pipelines as those companies come to market. But with the combination of the public market and the funding drought that we're experiencing, it does mean that price setting is back in kind of investors' hands, so we can have more of a say in terms of valuation. And then finally, the FDA, the US regulator for medicines, is experiencing quite a lot of turmoil at the moment. Paul's already mentioned some of the delays that we've had in the portfolio, and it's not just those smaller companies. Larger pharma and biotech are also experiencing delays in their applications. Essentially what this means for valuation is you have to try and now factor in a longer regulatory cycle, whereas before you had a pretty comfortable cadence between submitting something and then getting a response from the regulator. So if those are the kind of recent impacts on valuation, what are kind of the classical things to take into account? And that's captured in this chart, which is actually taken from a drug development paper, but the lessons are, I think, broadly applicable across healthcare. And so what you have here are in the brown bars, what you have here is the number of programs that were suspended, so ended either in phase 3, which are the brown bars, or when they were submitted to the regulator in the red bars. And so there's 4 groupings. The first one and the biggest reason something is stopped is because of efficacy. It just doesn't work. The next grouping is safety, and you'll notice that the bars are reversed. It's the only one with the bars reversed, and that's because in this case, drug development companies are much happier giving you something that's unsafe than regulators are. So at least the regulators are looking after your safety. The third grouping is commercial concerns, and then finally, you just don't know why something stopped. But I like these 4 groupings because they're essentially the way to think about healthcare risk and valuation. So efficacy, safety, commercial, those are all the prime concerns. And then unknown is a really good category because it essentially captures what the developer might not know and what you have to really try and dig into. So you have to really do your work around the known unknowns to really get your hands around a proposition. And so how do we put these different elements together and what we look for at Amati? So what we're interested in is generally later stage, lower risk opportunities. So we're kind of naturally skewed towards life science tools and services, diagnostics and medical devices. And actually when you look at this pie chart, which is a breakdown of the type of companies that we have in the portfolio, those are the 2 biggest groupings. Life science tools and services, and something we've referred to as unique assets, but those are skewed towards medical devices. So we also want a company to be funded to a value inflection point, and we'd like an experienced management team, and we do a lot of work getting to know management and understanding their capabilities, but also the development plan and the commercial plan that they put forward, and try and scrutinise that as much as possible. And so when we kind of delve into the portfolio, what we've got are these 2 large groupings, life science tools and services, and those are companies that sell instruments, consumables, or value-added services to pharma and biotech or diagnostic companies. And they are often exposed to high-growth end markets, but they generate revenue, and they have a significant, normally a significant upside from milestones and royalty payments. And so, for example, Maxite, which you can just about see, that has developed the leading technology for manufacturing cell and gene therapies, whereas companies like Aptamer, Fusion Antibodies, and Aracor provide development services to pharma, biotech, and diagnostic companies. And then the second large grouping is unique assets. So these are exciting, they have the potential to change medical practice. They offer significant upside, but as I said, they're skewed towards lower risk opportunities in medical devices. So Angle, we've spoken about. Polarian has developed a leading functional lung imaging technology that can transform lung imaging. Creo Medical has developed endoscopic surgery devices that can transform surgery and recovery time, whereas Intelligent Ultrasound has an FDA-approved AI-enhanced fetal sonography system that's been recognised by GE Healthcare and incorporated into their machines. And so if we dig in a little deeper, what are the things that we want these types of companies to have? What are the valuation characteristics? So For life science tools and services companies, all of those characteristics are essentially covered in this chart. So we expect them to either have or be capable of achieving a high gross margin. And so that's the green line at the top there. So Maxite, which is the most mature of this group, generates a pretty consistent gross margin of more than 88%. As I mentioned there, they're all revenue generating. That's shown in the red bars. And they can be profitable, but that profitability and that high margin requires scale. And that's really a function of number of clients, size of project wins, and that's really a function of time and the importance of their service to their clients. These companies tend to be valued on a price to sales multiple, and that's the light brown bars there. And the mean price to sales for this group in the gold line is, I think, just below 7. So what does that tell us? So Maxite, which is the most mature of this group, is only at a slight premium to that average. So that's despite having high sales, really good gross margin, and exposure to high growth end markets. And it's, I think, because the market is waiting for larger milestone and royalty payments to kick in before assigning a more premium rating. So Diaceutics, Aptima and Fusion are at a discount to that average, and that's because Diaceutics is still transitioning its business model to one that's more reliant on services and data. Aptima is really new to market, so it's still building its credibility, and Fusion Antibody has had spotty revenue growth due to the pandemic. While Aracor on the far side there is probably something you could describe as a valuation anomaly. So that share price has been driven by really encouraging data from internally developed diabetes programs, and we would fully expect that valuation to fall back in line with the mean as their financial performance pulls through. And so what about unique assets? So they're kind of a unifying characteristics. Well, I guess the most prominent characteristic is that valuation doesn't really follow a neat trend for this group. The share prices tend to move around sharply on news, but they are R&D intensive. They're creating something new, so they have to spend money to do that. They have to generate awareness from the bottom up in their industries. No one's going to know that they've created the best endoscopic surgery device, so they have to get out there and actually educate doctors about that. But they do make attractive M&A targets for incumbents because they just don't want to be displaced by the new technology. And so just a couple of examples of that, that share price movement. So this is Angle's 1-year share price chart. You can see on the far side there, so that's towards the end of May, so they have their FDA approval decision, and on the day, the share price jumped 60%, and you can see that there, but then you've got what we would suspect is probably profit-taking since then. And in our view, the market does tend to underestimate the time that it takes to transition from a commercial company to one, from a clinical company to one that's fully commercial once you have that approval. But for Angle, I think the building blocks are in place there, and it does bode well for their future. And then for Polarian, so in the middle of the chart there, last September and October, you can see a tick up in the share price as the FDA decision date approached. For drugs, the FDA actually gives you a particular date that they're going to deliver that decision on. For diagnostics such as Angle, or medical devices such as Angle, you don't get a date. You're just kind of left just to wait until you receive a decision. Then once Polarian got their delay, you can see characteristic overselling and then overbuying, and then subsequently the share price has essentially stabilized until the next decision date, which is the end of September. And so kind of putting those things together, so healthcare is a broad church of opportunities, and because of that, valuation can be tricky and challenging, and it's multifaceted, and it's also prone to bubbles, as we saw in the index charts. But Amati try and manage that through lower risk, higher profitability opportunities that have significant upside and the possibility to become world-class companies. And then there's further significant upside within the portfolio through unique assets. And that's it. So very happy to take any questions, and Paul as well, if there's more from his presentation. No? No? Yes?
Thank you. Can you give us an idea of how many opportunities you look at for the healthcare as opposed to how many you actually invest in the end?
Oh, so yeah, I guess you kind of have to kiss a lot of frogs. So there's plenty that we see that are just too early, essentially. So there might be drug development which is too early for us. So generally, we'd like something that's come out of a really good phase 2, and then going into a phase 3 and is funded through to essentially commercial launch. But because, as Paul was saying, we get a really good look at companies very early on. You might see something a year away, and you'd say, look, you're a bit too early for us, but we think what you have is really interesting. You need to kind of come back in a year's time, or maybe even longer, and then have another conversation with us. So a lot of what we do is company meetings, and that's just the name of the game for us.
Maybe I've missed something. It looks like the Amati's had great success in the IT space, but it looks like you haven't actually had that much success in pharma yet. Maybe I've missed something there, but I'm wondering whether you're kind of really still confident about your approach, given it doesn't look like you've had many golden bubbles going up that chart.
So the NASDAQ chart at the beginning, or just
generally in the Amati portfolio, whether the pharma's really paid off for you yet as a way of making money for Amati.
Pharma is a tricky one. We generally try not to do pharma nowadays. Drug development, simply because although we have certain expertise, we don't have a particular insight that will say that this drug will be successful in this indication because it binds particularly well to this target. That's just not something that I'm good at, but I know that if I can skew the portfolio towards lower risk, higher revenue opportunities, you just take that risk out. So with drugs, it is always challenging to say, this is going to be successful, because ultimately, if you look at drug success rates from, say, phase 1 through to approval, only 1 in every 10 drugs is going to reach approval, and then probably even less than that, maybe 1 in 20 is actually going to sell enough for you to generate a return. So we do try and steer away from pharma.
We can pick up more about that later in the break. So thank you, Gareth. That's very kind. So it's my great pleasure to introduce Jourdan, who's the CFO of Keywords, and he's going to come and talk to us about the company. Thanks, Jourdan.
Thank you very much, Paul, and thank you to everybody for having me here in this amazing building. It seems a bit weird to be talking about video games in these surroundings, but it'll be great. Before I dive into the presentation, I have a little video that I wanted to play. It's something we used at the start of our last management summit, and hopefully gives you a bit of a flavour as to what we're all about at Keywords. I'm hoping it clicks.
Get down.
woken us all up a bit, maybe, I don't know. Sorry, getting the technology to work. Right, there we go. So look, that just gives you a bit of a flavour for keywords. I should say Bertrand is our new CEO, and when he arrived, we launched a bit of a review of the business, trying to figure out together how we're going to move forward into the next chapter, and so that was really setting up the summit for the areas that we wanted to take the management team through. I've got a few charts I wanted to take you through. We just had a capital markets day last week, so it's a subset of the charts we took our investors through. I guess what I wanted to leave you with is on this chart, really. Firstly, we got a fantastic market-leading position within the supply side of the video game space. We're really, really grateful to be operating in a very large and growing industry, and we've got a market-leading position in that space. We've got a fantastic track record of financial delivery. I'll take you through that in a little bit more time. And we think we've got the opportunity to take the platform to the next level, focusing on some key areas that we want to work with on the business. So if I move on to the next chapter, just to... This clicker's not working very quickly, is it? Oh, there you go. Sorry, there seems to be a real delay. Apologies. So a quick snapshot in terms of keywords. We're the #1 provider of creative and technical solutions to the video games industry. Essentially, we help publishers produce the content, the games themselves. We've got 8 service lines where we're able to offer services across the entire value chain, and I'll go into that in a little bit more detail in a second. We're a global business. We're in 23 countries. We've got 70 studios around the world and over 11,000 employees, roughly a third in Asia, a third in Europe, and a third in North America. We work with the who's who of the video game industry. 23 out of the top 25 publishers. I always get asked about the 2 that we don't. One is a domestic China company, and we don't really have much exposure to domestic China. The other one is involved in gambling, and we kind of steer away from gambling-related games. But all of the top mobile producers, as I say, we're operating in a very large industry. The video games industry itself is well over $200 billion in size. Our piece, the content piece, about $35 billion a year is spent on content development, of which 11 billion is currently outsourced. But as I'll explain in a bit, the video game industry looks a little bit weird. It's very vertically integrated, and what we've seen over the last few years is quite a strong drive towards externalizing a lot of that content provision to the third-party markets. And, despite being the market leader, we're still pretty small. We're about 5%, just over 500 million euros of revenue last year, good profitability, around a 16-17% PBT margin, but as you can see, we're still pretty small in the context of our TAM. And these are the services. So this is the game development cycle. Starting at the beginning of the cycle, game development, this is where our software engineers use the game engines to actually create the game itself, build the game. We then we've got about 1,500 people in that business. We've got about 2,000 digital artists. So everything you see in a video game is what we call an art asset, and that needs to be digitally rendered by an artist. And we've got 2,000 people doing that day in, day out. We have audio studios dotted around the world so that we can actually bring actors into studios to record the voice that goes into a game. And then we have a bunch of services that are more linked to the launch date. We call them post-production services. So first of all, testing. Believe it or not, we've got about 3,000 people who are employed to play and test video games, if I was only a bit younger. We then have our localization business. That's where keywords started. That is taking the game and actually translating it into all the languages that the publisher wants to launch the game in. And unlike TV and film that follows a waterfall model, in the video games industry, you tend to launch your titles all in one go in typically 10 to 15 different markets. And we bring linguists in to actually help them with that translation. And then we then have a localization testing business, which is very similar to the testing business. It's just using linguists to actually look at the language components, make sure that that translation has been appropriate, it's culturally correct, etc. And then the final two areas are more about player engagement. We are at the early stages of building out a marketing capability. It's almost like a mini keywords. We think there's an opportunity to build the first global marketing agency for the video games industry. It's fairly early days, but it's building out quite nicely. And then we have a business that provides support to players. So think call center, but for video players. I said we're all over the world. We're in 23 countries, and this is really important. Not only do we need to have client proximity, so even in a digital industry like games, customers still want to be working with people that are close to them, but it also allows us to provide a 24/7 follow-the-sun sort of model. So people often want to be working in the same time zones, and we've got that within our business. It also gives us the opportunity to have nearshore and offshore, so we're able to offer slightly different price points depending on the particular customer. But it's also really, really important for talent acquisition. We're growing at around 10-15% organically, and it's largely a people-driven growth, and so we need to make sure that we've got access to all the different talent pools, and it's a lot easier to grow across 23 countries than it would be if we were trying to recruit into one location. And here's a chart with some of the names that we work on. As I say, it's the who's who. We're really proud of this. And what that allows us to do is sell more of our services into our clients. And you'll see over time, we've gradually been increasing the number of customers that take 3 or more of our services, the different service lines. But actually, if you look at the top 5, the top 10 publishers that we work with, very often they'll be taking 6, 7, 8 of our service lines. But importantly, we don't have too much concentration with a particular client. The top 5 make about 30% of our revenue. No single client is more than 10%. But it's really the bottom right-hand side, which I think is the most important. We've got a pretty sticky revenue base. We have customers that come back to us time and time again, long, trusted relationships. We have a lot of preferred supplier relationships where we don't know exactly which games we're going to be working on, but we know that a particular publisher always uses us for their testing or their player support. And then we have on top of that, about 30 to 40% of our revenue is what we call evergreen revenue. It's work that we just continue to work on all the time. And the best example of that is Fortnite. I'm looking around to see whether we've got any Fortnite fans in the room. But that's a game where they issue content every 2 weeks, and we've got one of our game development studios just constantly crank out new content for Fortnite, and they've been doing that for years and years and years. And if you take all of that together, about 80% of our revenue is repeating in some form or other, which is really helpful. And a bit of analysis of the TAM. I said it was a very big market, and we actually got some third-party research to try and help us size the TAM. As I said, about $35 billion of spend on content itself, but only $11 billion is currently outsourced, and that looks really unusual. And the analogy I would use would be the film industry. If you went to Universal Studios in the 1920s, they did everything themselves. They employed the actors, the script writers, the cameramen, the directors. They even had sets on campus. If you wind forward to today, a modern film publisher will fund and distribute, but all the means of production has been outsourced somehow to the third-party markets. Gaming is not like that. It's changing, but it's very vertically integrated. And so what we wanted to do was build a service platform that was there to be able to take this work as the industry matures and as they look to move more and more to the third-party markets. And you can see that coming through in the growth within the 11 billion. The industry as a whole is growing well, about 5% a year, it's predicted. But the outsourcing component is forecast to grow at double that rate, and that's that trend to outsource that I've been talking about, where publishers are needing to use third parties more and more. Having the same problem with the clicker. Oh, there we go. And what's driving that, you're probably asking? Well, it's basically becoming more and more complicated to build a video game. You're having to make it so that it can play on all sorts of different platforms, streaming platforms, the Xbox, the PlayStation 5, mobiles. It's adding huge complexity. They say it takes a village to make a game. A AAA game, which would be one of these big marquee games. They have budgets of up to $200 million for one single game. Internal teams of between 5 to 1,000 people. These are huge endeavours that take 3, 4, 5 years, and that complexity is driving more and more need for outsourcing. We're also seeing this thing called games as a service, which is, trying to illustrate this on these two charts. Go back only 5 years ago, a publisher makes a game, sell it in the shops for 3 years, and then 3 years later they make another game. What we're now seeing is what we call games as a service, where you make a game and then you constantly iterate that game and add content to it. And again, that's driving a need for more third-party support to help them manage that. And as I said earlier, we're the clear market leader. We're operating in a very, very fragmented landscape from a supplier perspective. As I said, we're only 500 million euros, but we're 3 times the size of our nearest competitor. And there really isn't anybody out there that's got the full suite of services, that kind of end-to-end capability, and the global scale and reach that we have, which makes us, I think, much more relevant to the largest global publishers. And on the right-hand side, you can see that we've got a fairly balanced business, which gives us that sort of nice suite of services across the broad development cycle. And that's allowed us to, I think, build up what I think is a pretty impressive financial track record. So for the last 4 years, we've had a CAGR revenue growth of 36%. Some of that's coming from M&A, which I will turn to in a little bit now, but really strong organic growth of over 10% each year for the last 4 years. And that's translated into a profit CAGR of 39% over that same period. So we've built up a track record of delivery over the years. And here we go. And M&A, this chart on the left-hand side shows how the business has grown since IPO in 2013. As I said earlier, we were a small business, 16 million euros of revenue, specialising only in localisation. That's where keywords comes from. But since that time, we've acquired 56 companies that have added about 300 million to our revenue base and created the platform. But importantly, that's created a platform that's allowed us to grow organically with over 215 or over 200 million euros coming from the organic growth. And that works out at an average of over 15% a year. And on the right-hand side, you can see the track record of execution between 5 and 10 acquisitions a year. It really is a well-oiled machine. Typically 5 to 10, around 50 to 100 million of spend. And you can see there quite a methodical process of building out the service line. So you'll notice in the early days, the dark blue squares for localization. And then once we got that to a level of global reach and scale, we moved on to the next service line. And our current focus is on our game development, so the pink dots that you see towards the back end of that, and also our marketing, so the white dots where, as I said earlier, we're looking to build out our marketing capabilities. So a really, really important part of the way that we've built the business out. And as I said, we've got a new CEO. We wanted to spend a little bit of time thinking about the strategy of the business. There is an element of don't fix it. When Bertrand was doing his due diligence, he spoke to the previous CEO, and the final thing Andrew said to him was, don't mess it up. It's been a very, very simple strategy. I think the business have executed well. But we think there are areas that we can take the platform forward. We've got some fantastic customers, but we tend to be a bit transactional with them, and we think we've now got an opportunity to elevate those relationships and make them more strategic. We want to bring more technology into our business. I would hope that in 2 or 3 years' time, when we're double the size, we haven't doubled the headcount. We want to bring more technology into some of our business to help automate and help us scale. We're obsessive about our culture, retaining the entrepreneurialism in the studios that's made Keywords so special, but also having enough of a spine so that they're getting the benefit of the platform and the back office services that we have. It's all about talent in our industry. It's growing fast. Talent's in short supply. We want to be a talent magnet, so we're going to spend a lot of time trying to build out our talent, focusing on academies, development paths for our people. And we're also having a look at some adjacent markets. And there are some natural places where we can take our expertise in games into some adjacencies. And the best example is media and entertainment, TV and film, where you're actually seeing game engine technology being used as part of the content production process. So some of you may have watched the Mandalorian series on Disney+. Everything you see in the back of that TV show has actually been rendered by game engines. It hasn't gone through the traditional filming process, and that's disrupting the way that TV and film gets produced. And we've obviously got 1,500 people that do that day in, day out. So we don't want to distract ourselves from games, but we do think there's an opportunity for us to take our expertise. And as I say, we're going to continue to focus on building out the business through M&A and keep building out our platform. So that's it. Before I hand back for some questions, a few closing comments. With a clear market leader, we're in a very large market, which I think gives us a lot of opportunity. We've got fabulous relationships with our customers. From an investor perspective, we clearly got exposure to the video games industry, but I think importantly, we describe ourselves as the picks and shovels of the industry. We're not the gold prospectors, so it gives you an opportunity to get exposure to the industry, but without that hit and miss risk that you sometimes get with publishers. We're across the whole of the cycle. Say we've got fantastic geographic footprint, really diverse skill set, and we think that gives us a fantastic opportunity to take the Keywords business forward over the next 2 to 3 years. So I will pause there.
Fantastic. Thank you very much. Thank you, John. At the risk of getting in between, doing the very unwise thing of getting in between an audience and biscuits, we've got time for a quick question or two if anybody wants to ask something. Otherwise, are you able to stay for coffee? We can,
yeah, I can hang around
catch John. Yeah, yeah. Go for a quick question here.
With the skill sets you have globally, I assume you really have a lot of people that could actually develop games themselves. I mean, is it actually something you're thinking about, even on a small scale?
It's a great question. I wouldn't say we think about it. We've made a decision not to go down that path. It's fantastic when you see these games. Fortnite's a great example. Explodes, but for every one of those, there's another 10 that don't make it. And we're very happy to be pretty humble, client-serving, behind the scenes, helping in the industry, but without putting our balance sheet, our capital at risk. So that's the line that we won't cross. We also don't want to be seen as a threat to our customers. We're a bit like Switzerland. They need us, they want us to help, but we're not a threat to them. And I would worry that if we started to take the muscle that we've got to invest in our own games, we might be seen as a threat to our customers.
Great. And there's just one more question here.
Yes.
I'll just wait for the microphone. Okay. 1 second. There we go.
Thank you. With the rise on an improvement of artificial intelligence, you've got a number of areas which I can imagine might be in the future replaced or sort of improved, perhaps, with artificial intelligence, like the translation to different languages and so on. Do you see this as a threat, or are you trying to actively use this technology?
Yeah, I think a bit of both. You're absolutely right. I think in that post-production world, we'll be testing games very differently in 5 years' time. I'm absolutely sure. That's why we're focusing on technology. We actually have AI capabilities in the business. In our localization business, we've got a machine translation capability. We're being very careful with how we deploy that. But yeah, absolutely, there are some areas of our business where I think there's an opportunity to use technology to improve the way we service our customers, but also get out in front of the potential disruption that the technology could create. So we want to lead that process within the industry, and that's why we want to spend more time focusing on technology.
John, thank you so much for giving us the insights into Keywords. That's been valuable. So now we're going to have a quick break, and if we could meet back here at 10 to 4 for the presentation from Sayeta, that would be great. Look forward to chatting to you. Great, welcome back everybody. I've been accused of mis-selling because there were no biscuits. I apologise about that. So, I'm sorry. Yeah. But there will be some food at the end for those that can stay. So it's my great pleasure now to introduce Wicher Kist, who likes to be called Vic.
Yeah.
And Vic is the CEO of Saietta. So I'm just going to hand over him and he can tell you about the company. Thanks, Vic.
Thank you. Is my microphone? Yeah, it's working, isn't it? Let me just rehearse this. Yes. Excellent. Very different presentation. Everybody okay? So Sayeta actually means thunderbolt in Italian dialect. I don't look very Italian because I'm also not the founder. The gentleman who founded Sayeta wanted to be the Tesla on two wheels. He fell ill in 2017 and developing full vehicles, as I know through my 25-year career, is very, very difficult. I believe the i3 for BMW was somewhere around 3 billion development cost. So you have to have good, deep pockets to develop full vehicles to go into retail. But what I recognized through the EIS investors, I was actually catapulted in as the interim CEO, and I found something in the company that I was like, wow, this is actually the jewel. And it's actually this little motor. It's an AFT, actual flux technology motor. And we were able and blessed through the UK SEIS and EIS investment schemes, which in my home country in the Netherlands, we don't have such a scheme. So thank you for the UK government to allow this, because there is so much deep tech. I mean, we're in Motorsport Valley, Oxfordshire, Northamptonshire. There are so many startups now in existence thanks to that EIS investment, and I reiterated that at the AIC conference yesterday. It's very important that we keep that. Sayetta is one of those companies that came out of that, and I realized that this wonderful motor first needs to be patented. So I love talking about Sayetta, but I wasn't allowed because we would lose the IP. So we had to be really, really quiet for 3 years. And then we landed a big order in the middle of the pandemic. And through the network, we were introduced to Canaccord, and suddenly I was introduced to Amati. Paul Jourdan received a lot of coaching, and Amati basically made the IPO possible by investing into the pre-IPO. So a big thank you to all of you for making this possible, because this is a very capital-intense business. And bless you. The reason why we are so motivated to do this, the motor, I can make the motor as big as a wind turbine motor, 3 meters in diameter, and if you turn it the other way around, it becomes the most efficient generator on the planet. But you can't win them all, so you have to be smart and you have to pick the right market. I was actually in London this morning, and I'm a little bit strange sometimes. I like driving in London without the air conditioning and the windows open, just to experience how dirty the air is. Because surely, if you don't experience that on a regular basis, then you don't understand the urgency. And this is, like, we could have developed this motor to become like the best electric motor for Tesla. But let's be honest about it, Tesla is not where the volume is. The volume is little scooters, motorbikes, last mile delivery vehicles, and then you skip the midsection. VW can look after that segment, and then you look at buses and trucks. So that's, and we do that because we believe that cleaning up the air in large cities around the world is important, and we have the technology to make an impact. This was actually me in the car this morning. It took me 60 minutes to do 3.9 miles. And I have no idea why there is a diesel engine in that big red box driving around in the middle of the center. So for that reason, I turned around Sayeta. I'm very grateful for the IPO, because that really changes things. And I'll take you to that journey of what happened over the last 12 months and where we are going. So the motor tech, very special, focusing on light duty and heavy duty. We pretty much offer a suite of engineering integration services. I worked at Cosworth Technology in Northampton as part of the Audi group for many years. That's where I was trained, that's where I learned that you can charge for those services. A lot of these manufacturers, like a little scooter manufacturer in Thailand, they make, I don't know, 2 million scooters a year, and then they want to go electric because the government has told them they must go electric, and 50% of their volume needs to be electric in 2 years' time, and they're just like, no idea how to do that. All we know is that we must buy these batteries from this local factory because it must be localized content. So we pick up these type of like inquiries and we basically help them to go to production as quickly as possible. We listed, raised 37.5 million. We were offered more. You found the phone.
Sorry.
That's all right. Happens to us all. Again, AIM, green economy, fantastic. Lower thresholds. My entire board was extremely scared of like, oh, AIM listing, penny stocks. We don't want to be there. But I think that market has been cleaned up fantastically well. And Canaccord, as our broker, has done a fantastic job. So what do we offer to the market? It's basically full eDrive solutions. So we did a small press release about it yesterday. I had a personal passion that also Paul fell in love with, which is the marine application, Propel. That's mainly because there is another company which is only 6 years old and they're already doing 100 million turnover at eye-watering margins. So I'm like, hang on, I can do that better. So we've added that into the group and we just won an award. And through an acquisition of an Evergrande company recently in November, we now have all the inverter technology in-house. But also a full bus solution. That's the power of money. I'll tell you more about that in a minute. So the challenge post-IPO, first of all, I was really scared of the money being taken out of the account again, because when you do like EIS funding, it's like you're really like, is this real now? And like, can I start the plan? And we could. The big challenge ahead of us is to transition this R&D company to become a manufacturing company. And that's a big task. Especially while the legislation, always the best motivator to change something, and the automotive supply chain is 3 trillion in value, and I think about 15% of that is in flux. 90% of all of our inquiries, vehicle manufacturers from around the world, basically have gone to Dana, and Dana said, sorry, we're sold out. Anyone who can bend a piece of copper and make an effective, efficient electric motor should be sold out for the next 15 years. And it's almost like how much money can you raise to then grow faster? Again, that's why the IPO is so important. Step 1, I knew one of the Achilles heels was that we didn't have the inverter in-house. And the inverter, for road safety compliance reasons, is almost 11 years of man code. And like gaming software is one thing, but also the software to make sure that these buses don't go out of control is very critical. There's a company where I actually got my degree in the Netherlands, Apeldoorn, called eTraction, and in 2017 it was sold for 55 million to Evergrande. And Evergrande, as you know, had a slight issue with some debt, I think 300 billion of it, and they couldn't afford a tiny little 55 people team causing bad publicity. So I was literally in Slovenia trying to buy an inverter company, and they wanted like 10 million, and the next day it was 30 million. I was like, this is never going to work. How am I going to bring this tech into the group? The fact that they needed a buyer quick was only in the Dutch press. That's another language that I am quite fluent in. So I jumped on a plane straight back to Apeldoorn, and I was like, what's going on? And they wanted 30 million. And by the afternoon, it was 10 million. And I was like, that's 1/3 of my raise. It's like, I can't afford that. Plus, the company's losing quite a lot of money. That needs a turnaround. But it had all the inverter tech in-house. They rang me on Sunday morning, and they said, you can have it for 2 million euros, not even pounds. And we got it. We got it. So that really allowed us to bring all of that inverter tech in-house. And then in parallel, I also knew that we didn't have the manufacturing capability in-house. And through a friend who just sold his business to Turntide, the ZF factory in Sunderland was going to be closed down. So that there used to be 400 people there. They've made 25 million small electric motors for power steering pumps. And my chairman and our chairman, by the way, is Tony Gott. Tony Gott is the ex-CEO of Rolls-Royce. So he relaunched Rolls-Royce at Goodwood. And he's one of those type of guys. He's a strong mentor for me. He's one of those type of guys. We said we start production on this date. There was no roof on the factory yet, but production started. Getting things done. So the two of us walked around in Sunderland and we were like, okay, what's the state of the gutters? And all we wanted was a really good proposal to then pretty much like strangle Oxfordshire to give us a better deal to build a new plant in the Midlands. And they suddenly started showing us all of these workstations. I was like, here's a weld station, and here is a... and I was like, oh my God, but are you leaving the equipment? Yeah, we're leaving everything behind. The specialists are saying somewhere between 25 and 50 million is the value of the kit, and most of it we can repurpose for our production line. Follow our news on Sayetta.com. I need to speed up a little bit. What we've done since the IPO is now the company now pretty much has 3 performance units, which is light duty, heavy duty, what was e-traction, and the Propel Marine division, and Sunderland as the manufacturing plant. But what's interesting is that we also have our joint venture in place in India. We selected Padmini. They have a 100 million turnover themselves. They are really close to the Hondas and the Bajajas and all these large manufacturers. And don't forget, India, they register 23 million vehicles a year. Of the 23 million, 20 million are two-wheelers. So that's why we designed the motor, the little motor, the way we did. The demand is so strong, and I am so sorry that the right stuff is not in the press yet, but that will change over the next weeks, months. Automotive is a long game. Like when you talk to a client, it can easily take 2 years before you have the contract. But one of those contracts could be in the region of like, I don't know, 2 million motors a year at about $100 per motor. You can do the sums yourself, and you work on like 5 to 7 year contracts. The good thing is that we have one line to build. We can just as well build 2 straight away because it has to be made in India. We like India more than China, by the way. It's, no doubt in 3 or 4 years' time we can start looking at China. Right, very quickly, axial flux with integrated inverter, now fully done in-house, and we own the software, and we can make that into a full e-axle. For that application alone, you're talking 300,000 units per year. Triumph rang the other day, and we were like, well, it's only 10,000 motorbikes per year. We're talking to Hero in India. They do 7.6 million motorbikes per year in the right segment. And don't forget, lightweight mobility, you can work with swappable batteries, something that we've been doing in Holland for 15 years with pedelec bicycles. And you don't carry your bike to the apartment or throw an extension lead over the balcony. You just pull the battery out and take it upstairs and charge it. This is a gift. The fact that we've now got this in the group is a gift. I won't go into too much detail, but the main focus is the power electronics. That has saved us years and years and millions. Now, going back to marine, why am I so obsessed about it? This company, 6 years old, they took an off-the-shelf electric motor and put it below the waterline. In the Netherlands, you don't tend to buy bicycles, you steal them, and when you're finished, you throw them over the fence. And then the bottom layer of the canal, they physically have dredges, like, to make sure that the boats don't hit the metal. You hit the metal, the seal starts leaking, water is in the motor, it stops. People hate this machine, and still they sell around 35,000 per year at 11,000 euros. An electric motor I can sell for almost like 300. An electric outboard like ours, we can sell for, it's online for 5,900 euros, and we're pretty much sold out. We're trying to find ways of getting production started. It's also a celebration of the actual flux motor, so the pancake shape, and as a result of that, we have just won the Red Dot Design Award. And that's very, very prestigious. The video on the new website, which will go live in a few days' time, there's a lot of simulated pictures. I just wanted to show you it's real. How we have vehicles on the road. We have those clients that are sampling our motors, so we're on the case. And it looks very different, but the funny thing is that all of these applications run the same software. They pretty much require the same skill base, from scooters to buses. The other application, like people are ringing me like, oh, I've got a Riva on Lake Como, can you like put 300 horsepower electric motors in it? Yeah, I can. But you probably need a battery that's about 300,000 euros to do a full throttle there and back. This is what we do in the Netherlands, but also in Germany. It's 6 kilometers an hour, and it's all about peace and quiet. People that have been doing this for years, they're just like, when they suddenly hear the birds singing while you're, instead of like, all day behind you, it's not relaxing. This is relaxing. By the way, our partner in the north of Holland, this is actually a 3D printed boat from recycled plastic. Not our product, by the way. Very quickly on, I hope it starts.
Improvements to our transport
This is
system
the big,
are powered by
the
our
big solution
technological
that comes straight from
advancements.
e-traction.
Increasing
Of
the
course, we still have it
efficiency
in
and the
production.
economy of our vehicles is
But what is
driving
interesting-
innovation forward. As we enter the era where electric power achieves mainstream adoption,
You'll see a diesel
the traditional
engine, like that
transfer
diesel
energy
engine in
from
that bus
engine
in
to
London.
wheel is inefficient,
And it
noisy,
evaporates.
and high maintenance.
All of the tech
But
that
what if
comes
there's a
back in
simple,
is
quiet,
now
and
owned
efficient
by
way to
Sayeta.
power our vehicles that use a fraction of space of conventional engines? Direct drive, in-wheel motor technology substantially reduces energy losses by eliminating all gears and the majority of rotating parts. The unit provides power from battery to wheel at 94% efficiency, outperforming the electric
There's a
powertrain
module
benchmarks
coming up
by
in a
to
minute,
15%.
and as soon as the
This
Indian
in-wheel
clients
motor
hear
setup
that we have
also
that
reduces the
module, which
number
is
of
that
moving
module there,
parts,
it
massively
connects
lowers
it
the
back
operational
into the
maintenance
bus.
costs,
The value of that
providing maximum
module
driving
alone
comfort
is somewhere
with
close to
minimum
like
noise.
25,
This
30
combination
million.
of factors
So
gives Sayeta
our press release does not reflect what we did over the last 12 months. But of course, we have to be careful. Our revenue is still low. It's like it's shooting up really fast. But we first needed to plug those holes and make sure that we had that knowledge in the group. So there's Silverstone, there's Apeldoorn, there's Amsterdam, and this is how we add value. You want to go electric as a vehicle manufacturer, we will help you do it, and you can even make it anywhere around the world yourself. To clean up the air in large cities around the world. That's what we are about. Thank you.
Yeah, thank you very much, Vic. That was fascinating. We have time for a couple of questions if there are any in the room. Just please wait for a microphone to come. So, why don't we, if you ask your question, that would be great. Thank you.
Does your motor use rare earth magnets?
Yeah, there's different theories about that. First of all, our motor uses non-segmented magnets, which helps the recyclability and keeps the cost down. But indeed, all of these applications are permanent magnet motors. But even the European Union, India, nobody wants to be dependent on only China. So there is mining projects around the world. When you talk to the inventor of this motor, Dr. Chris Lyons, our head of R&D, he can explain in exact detail that this is the least rare earth of all the magnets. What we shouldn't forget is that if we sell 100 million vehicles per year around the globe, and that market will decline because we will switch to like last mile delivery vehicles, I guess pretty much everybody here has at least one car, if not two, and all of your cars have a starter motor and an alternator, and they already have magnets, and they've been producing these for like the last 110 years. So it's, yeah. Does that answer your question?
Thank you. And one at the front here. Thanks.
Who are your competitors?
There was one, Yassa, and they were 15 miles away from us, but they only focused on 800 volts. So what we strategically did 5 years ago is focus on low voltage first, because that's harder. You might remember it's current times voltage gives you power. So if you have a high voltage, your current can be lower. But you then need specially trained staff to then maintain these vehicles. If we put 800 volt scooters on the road in India, there will be casualties. You can kill yourself. So we focus on low voltage. Yassa, because they didn't float, they came out of Oxford, they grew very close to Mercedes, and Mercedes couldn't meet the warranty conditions because they were a small limited company, so they bought Yassa. So Yassa's already been moved out of the way. But the role model, if you're interested, go to danatm4.com. They're pretty much the market leader on electric e-drives.
The reason why I asked, because it's really a very good presentation, but I still don't understand what is at the core of your specialism and what is, what you do. Is it batteries?
No, electric motors. We are Sayeta electric drive. So for a vehicle, that's a very good question actually. The Canaccord pulled me up on that one yesterday. For an electric vehicle, you need a battery, an inverter to take the energy from the battery and make the motor run, so DC to AC, and you need an electric motor. We focus on this part, we don't do this part, because I've done a lot of work in fuel cells, and the risk is that someone clever wakes up tomorrow, invents a new chemistry for a battery, and we're out. Whereas every e-drive system will always be a combination of metal, copper, and magnets. That's why we focus on the e-drive, not on the battery.
Okay, thank you very much.
And we've got time for one more question. Peter.
Have you looked at, I'm sure you have, and it may not be that big, but how about golf buggies? Because at the moment they weigh a ton, and there seem to be an awful lot of them.
Yeah, a good friend of mine, Lloyd Ash, you know him as well, so he sold Ashwoods to Dana, so they have a little electric motor. They seem to be pretty high up in the golf carts world, because they refuse to implement a coolant system. Whereas in Asia, what we see now, like friends of mine have electric cars in India, they come out of the supermarket, they get in the car, there was a heat wave recently, and the car was already like overheated before they even like keyed on, so that the vehicle wouldn't drive. So there is more challenges ahead, but the point is that if you look at, for example, Piaggio with their 300,000 little tuk-tuks versus the golf carts, with Piaggio, they will, if I can make that e-axle for about $600 and I can sell it for $1,200, that's a nice margin business. The golf cart people, they're tight. They don't want to pay anything, basically. It's like they just want to have a milk float solution. So we're the next level up.
Her Majesty the Queen just took delivery of a very nice one from Denmark.
Yes, yeah. It's we're close to Bicester Village, the designer outlet, and you have all these people from China, and they've got these really luxury like golf carts to take them to. We can go into that market, but to be honest, I think we are laser focused. We know where the high margin.
Bigger fish to fry now.
That's it.
Thank you.
Thank you.
Fantastic. And sorry, we have one more question here. Yeah, thank you.
Excuse my ignorance on this, but does any battery, how does this fit with the battery suppliers? Can any battery supplier fit you?
Yeah, we are battery agnostic. I'll go even further than that. We don't really care where the energy source comes from. So it can be a fuel cell, which can be ammonia, hydrogen, ethanol, methanol, or lithium, or even AGM batteries. We have an opinion about batteries. We know what batteries work, what don't work, what horse to back. But what is interesting is that at this global level, like I recently was in Mexico for another client visit, they want to set up a plant over there. And they already said, like, okay, the government has invested heavily into, I don't know, British Volt. Like in Sunderland, our version is British Volt. And it's pretty much like if you want to have your future vehicle subsidies, then you must source the battery from that plant. And pretty much every country around the world is doing their own things with batteries. But everybody's forgetting the e-drive, so that's where we got it.
Fantastic. Thank you very much, Vic.
Thank you.
A really good update. Thank you. So it's just gone 4:15. The idea now is to have 12, 13 minutes of more wide-ranging conversation. I've titled this strategy. It's not a particularly scripted section, so I'm going to try and focus it on things that I think you might want to hear about. And obviously, if you have particular things you want to hear about, please do put your hand up and ask, and I will cover them. And just to give you an idea where we're going, at 4:30, thereabouts, we'll have a couple of the former winners of the Amati Creative Entrepreneurs Award from the Guildhall coming to give an update of how they're getting on. The reason we're not running the award this year, we thought we could, but then we realised that the course hadn't been run at the Guildhall, and it would have been a bit difficult to run it with people attending next year because it's a little bit premature. So in a year's time, we can hopefully run a new prize again. It's been a little bit frustrating in the pandemic not to be able to have it, but I think we've got two very interesting updates for you coming up at about 4:30-ish. So on strategy points, I mean, maybe a good place to start is to say that you will have noticed that over the past couple of years, a lot of our new investments have been focused on the energy transition kind of arena, hence Sayeta are all about electric vehicles. We've looked at really a large number of technologies that are enabling technologies for energy transition. And clearly this is an area of great focus. It was talked about an awful lot, of course, last year around COP26. And in all the excitement of energy transition, it's I suppose one of the things that has always struck us is that actually energy transition is really minimum a 30-year project. So this is not something that can happen anywhere near as fast as we'd all like it to happen, because the reality is the problems that you have to solve are very difficult, and as you've picked up from Vic, even when you've got a great new technology, scaling it up and creating hundreds of millions of these devices, it's a really big project, and it takes time, it takes a lot of capital, it takes a lot of focus. But it's also very clear to us that if we're looking at that kind of time frame, that the world in general, the world economy is going to focus an awful lot of economic activity on energy transition. So hence our interest in making investments in that space, because in the kind of time frames that we're thinking of, we can see a lot of top line growth coming into these businesses. And if you like, when you're making an investment at the kind of stage we are, what you're really asking yourself is, can I find a business where I'm really going to see that kind of top line growth come through? Because that's what will drive a successful business in the long run. And so clearly this energy transition space, there's a lot of opportunity. But of course, wherever there's a lot of opportunity, there's also a huge amount of competition. So it's good to have a question about the competition for Sayeta. And one of the things that attracted us to the electric motor market is that there's relatively little competition in the electric motor innovation space relative to batteries, where there's unbelievable amounts of capital being thrown at the battery problem, and the battery problem is very acute, and we can't really have the kind of rollout of electric vehicles we really want without better battery technology. And whenever you talk to battery technologists, they will all have a chart of how much better batteries are going to get in the next 10 years, but that still has to be delivered. But it's pretty hard for us to find the winning company that can create that battery technology company. Those of you who were watching our presentation last year, we talked about Ilika, so we did invest in a battery technology company. Actually, we made a lot of money out of it. It was a fantastic investment. We took the decision to exit that, and you'll see that in the reports. I suppose because we were just very acutely aware of the ferocity of competition in that space. And one of the features of that market is it's already become a market where you have to be quite big to succeed. And so the big Chinese battery producers, and outside of China too, but it's really dominated by China, they just have a massive advantage of scale. So in a way, they are going to determine, I think, how the battery technology market progresses, because even if somebody comes with a brilliant new technology, going up against that kind of scale competition is very difficult. It's not. We continue to study that market, and I think there will be some fantastic developments in it, but they're A, not going to be quick, and B, really what you have to look at is who can scale up. And it's a similar thing with Sayeta. You know, they now have this challenge of talking about, you know, very, very large numbers of motors, and from having made none, that's a big journey to go on, and it requires capital, which is why the IPO was actually so important for Sayeta. It's what created, you know, an opportunity to get going, and a lot of, you know, frustratingly, a lot of British companies they come up with something brilliant and new, and they have this problem of, you know, how do you get off first base if what you need is £35 million, which is what Sayeta needed? It's difficult. You know, I've seen other companies. So something I'm particularly fascinated by myself, carbon capture and storage. Partly, I'm fascinated by this because, you know, I don't think we can solve the climate problem anything like without carbon capture and storage. I just think we're kind of kidding ourselves if we think we can do it without that. So we have to get to a point where we start capturing that carbon again and basically removing it from the ecosystem. And you know, unfortunately, planting trees is great, but it doesn't remove the carbon. It's still there in the ecosystem. It'll come back within a couple of generations. What I'm talking about is removing it, putting it back where it came from, underground, ideally crystallizing it so it can't just escape. And that's all possible. It is the solution to a big part of what we need to do. But you know, there's a fantastic company I met in the UK who have really nice advance in this area of technology, but they need like £100 million to do it. And you know, at that point, it's not something that's too big a problem for us to solve. So hopefully that problem can get solved because of it, the importance of it. And it's one of the things I'm very aware of. You know, we're looking at a lot of really important technologies and we want to get them commercialized, but we have to kind of do what's possible for us and you know, try and bite off a bigger problem than we can solve. But you know, I think luckily Sayeta was the right kind of size as well. It suited the AIM market to give it that kind of amount of capital, and we could play a bridge in getting them from being a really underfunded private company that couldn't actually afford to float, giving them some money to do that, and then fortunately they had a successful flotation, and it's really kind of got that company moving. So I think with Ideagen having been sold, you know, ideally what I'd like to find for the portfolio is some other software kind of businesses, because we really like the business model of software companies and the opportunity for software companies. So it's something we'll be looking at. They tend to be companies that don't need as much capital as the kind of things we've been finding. So actually part of the challenge there is engineering or discussing with these companies, persuading them to float. They don't have to float, but where it's appropriate and where we can persuade them to, hopefully we can find some new software type investments. So that's one of the challenges we've got over the next 12 months in terms of how we deploy capital. It'd be very nice for us to find some investments like that. I think I just made a couple of comments on the energy transition, on the energy crisis that's looming. So one of the things that I don't think is featured anywhere near enough in the public debate about energy transition. We've had all the kind of ideals how we want to get away from carbon, but what we're very bad at doing is facing the fact that we are still massively dependent on oil and gas. However much we don't like to admit it, our level is still at 85% of our energy use is coming from oil and gas sources. And the big danger of forgetting that is that we just do something relatively crazy, like just trying to shut down our own oil and gas production ahead of shutting down demand. So for me, energy transition is all about changing demand. What you can't do is mess around with supply, because if you mess around with supply, what happens is you don't stop buying oil and gas because you absolutely have to have it for your life. So you just buy it from somewhere else. So you know, it's surprising to me that this sort of has become something relatively radical to say that actually this is not a supply problem, this is a demand problem. And if you try to treat it as a supply problem, all you do is you create a huge crisis. But because it's being treated as a supply problem, and there's a vast number of people out there who think that the answer is you shut down oil and gas supply, actually all that does is it creates an energy crisis, and that's kind of what we're entering. where there's massive underinvestment in energy, in oil and gas, and it comes back to, it creates huge dependence on regimes such as Russia, Saudi Arabia, Iran, other Middle Eastern countries, Venezuela, if they can produce it and they can't. You know, the big resource-cursed countries, these are resource-cursed countries, and that's a whole other topic that if anybody would like to explore this in a lot more detail, we're, Amati is, along with Clean Trade and King's College London, we're putting on an event in about 2 weeks' time, 27th of June in the afternoon, entitled Breaking the Link Between Oil and Gas and War. And if you like, that's, for me, that's really the central thing we need to focus on in relation to oil and gas, is how to stop our consumption of oil and gas just creating more and more conflict and violence around the world, which it does do very, very easily. And so I feel, in terms of supply, that's what we should be focusing on as a society, not trying to wipe out supply while we still need it, because the problems that's creating are immense, and they've erupted this year. Not unpredictably. This was a very predictable problem that's arisen, the kind of aggression that we're seeing from Russia. So that's enough on that. But if you're interested in the event on the 27th, please do email us. We'd love to have you along, and you'd be very welcome to come. So just very quickly, what's been happening at Amati? We have, as many of you who follow us will probably have seen, we've launched a strategic metals fund a year ago, and that was very much cognizant of the fact that these new developments like the motor we've been seeing from Sayeta, electrification of our economy, replacing oil and gas demand with other types of energy demand, that requires a huge amount of metal, and metal has become a very strategic asset. And the topic of rare earths was raised earlier. That kind of discussion is replicated in a whole range of different metals. So we started a fund to really focus on that, and we're incredibly lucky to find two really world-class mining investors who run that fund. So, please do ask us questions about that if you want to follow up on that area. And then just very quickly, our latest project is we've launched a strategic innovation fund, and this is really a very different kind of fund to anything we've done before, because this is really focusing on much larger companies. The average kind of market cap of that fund will be between $30 and $50 billion. So it's really more of a large cap fund. It's a global equity fund, but it's trying to capture some of the same innovation themes that we're looking for in the VCT. So we have an incredibly fruitful dialogue, and it just so happens we've got one of the managers sitting on the front row. So I might just drag Graham up just so you can meet Graham. He's one of the managers of this fund. But I thought it might just be useful to just to give you the flavour of what we're trying to do with that fund, and to how looking for innovation themes kind of goes across the market cap spectrum. It's just to have a literally 2-minute ask Graham a couple of questions. So, Graham, because we don't have long, maybe just tell us very quickly what you're trying to do in the fund, and then maybe how some of those innovation themes relate to what we're doing in the VCT.
Yeah, great. Well, I think a lot of these kind of themes have come up today, and certainly energy transition is one of them. But what we're trying to do is to look at those big changes, that we call them innovation frontiers, and look at how we can invest in companies that are really benefiting from those changes. So we're looking at the themes, but we're doing a lot of very detailed kind of looking at the stocks, so that we can find really interesting ideas from the bottom up. So very concentrated portfolio, 30 to 40 holdings, companies where we see some of these really big innovation changes benefiting that company. And a good example, maybe Vic mentioned in his presentation about how he's addressing the low end of the kind of electric motor EV market, and he mentioned Volkswagen will take the mid-ground. Well, we kind of agree with that. So we have a stake in Volkswagen, for example, which is going to be by 2025 the biggest producer of electric vehicles in the world. Trades on 6 times earnings compared to Tesla, which trades on 70 times earnings. So, it's finding these really interesting businesses where they're getting enormous amount of potential growth from these changes, these innovation frontiers, and then digging in and sort of rifle shot investing in the best ones we can find.
And perhaps just give us a flavour of one of these innovation frontiers, a different one that you're looking at.
Yeah, well, maybe an extension of that. If you think about electric vehicles being a growing element, well, something has to provide power to those electric vehicles. And if you think about the way the energy networks are changing, we're going from having a few very big producers of energy to a much more dispersed creation of energy through wind and solar. And all of those generators have to be connected back to the grid, and then that grid has to be connected to the transmission network to feed the EVs. And so there's an enormous amount of cabling that has to go in to provide that infrastructure. And so there are companies, we own a company called Prysmian, which is an Italian business, the leader in that market. That just stands to have an enormous amount of growth from those big trends. So it's a matter of, and this is not a high-tech business, this is a cable company. It is a very innovative business. But you can see that you can find these really interesting companies that don't trade on ridiculously high multiples, but have an enormous potential, growth potential, because of these innovation changes that are happening in the world.
Thank you, that's fantastic. So hopefully that just gives you the flavour of how we've been growing at Amati, and we're trying to extend the reach of our, if you like, intellectual capital in the business. And we're now, it's fantastically instructive for us to have this global equity fund working next to us, and we can exchange a lot of ideas. And it's useful for us running the VCT to be able to, what we're always trying to gauge is, well, is a big company going to come and take this whole market? Is there any point being a small company in it? Or is there actually a gap where something a small company can produce can really effectively sell into the large businesses that are out there? So again, this is quite an important development for our business, but it's helpful for the way we can evolve our thinking. And with that, I should ask if there's any questions before I'm proposing not to wrap it on for too much longer. So yes, but we can take some questions.
Can I just ask a question across the generic theme of the vulnerability to interest rates? Because obviously what's going on at the moment is the fear of interest rate rises is both threatening the markets from a series of... So from the AIM, from Amati's perspective, in both the AIM and in the smaller companies, what's your perspective? Is it because of deleveraging of other investors? Is it because of the cost of debt going up? Because in things like healthcare, demand's just going to keep going up. In the raw numbers, with inflation higher, the numbers will get bigger. So you sort of look at it and think, well, why are all the valuations getting hit so hard if demand's going up? Is it because of deleveraging? Is it because of the cost of debt, or is it something else? Okay,
yeah, really good question. And yeah, it's an important thing to touch on. So there's two things really, important things to say with that. One is because these concepts don't always get conveyed properly. So the reason why rising interest rates and rising inflation brings down the valuations on the stock market. So this is a de-rating issue. So you've got the same earnings, instead of being worth this much, you're maybe worth this much. It's to do with the discount rate going forward. So when you calculate the value of a business, we use this word discounting, and it's not like discounting in a supermarket, but it's like you're looking at the future stock of earnings, and you take your effective cost of capital, and you subtract that from the future earnings. So if those earnings are 5 years away, and it's costing you 6% every year, your cost of capital, you've got 5 years of 6% to get it back to today's value. But if that cost of capital goes up to 10%, you're discounting by more aggressively every time. So your today's value goes down, of the worth of future earnings goes down at today's price because your discount rate's gone up. So that's a big part of what's going on with the re-rating at the moment. And then in terms of, there's another sort of big element which is not that well discussed, I don't think, in the sort of general economic news. So of course interest rates is a big driver, but actually a even bigger driver than interest rates since the great financial crisis in 2008 has been QE, quantitative easing. And quantitative easing was done actually very cleverly for about 12 years after 2008 in a way that kept the supply of money in the economy pretty static, growing at a pretty static rate. It grew at 5% a year every year from 2008 to 2020. And this is broad money, so this is every form of money. And what that means is you're keeping your demand pretty stable in the economy, and it's continually growing, but it grows at a similar rate. And that's very good for having a steady state growth economy. But what happened in the pandemic was the central bankers decided to pump massively more money than that into the economy. So the money growth in the pandemic in the UK was maybe 13%. In the US, it hit 20%. And there hadn't been anything like that happen since World War II. And so that's really what's behind this high level of inflation. Now, it was actually central bank policy really errors. They just got hugely over-reliant on QE. They couldn't believe that quantitative easing would cause inflation, having had such a long period when it didn't. But they kind of forgot that actually it didn't, because it was really well managed until that point. And most of them had given up on any kind of monetarist thinking, didn't believe there was a link between the amount of money in circulation and inflation, and they've just been proven mightily wrong. And actually it turns out there is that link. And so in a way, what I think will happen next is this inflation will be quite persistent, but because we're now going to go into a phase of QT, quantitative tightening, so as well as higher interest rates, that money is going to be withdrawn from the system. So there's quite a big danger now that money supply goes negative. And if that happens, we get quite a sharp recession, but you also get asset prices going down just because liquidity everywhere in the economy will get a lot tighter. So there's those two things which are derating companies. It's impossible to say. It's very difficult to predict anyway. Well, how far does this go? When does it finish? I wish I could stand here and tell you, we look pretty hard at these things. I would say I don't think it's finished yet. But if it's well managed, the duration of the kind of painful phase can be relatively limited, and in a way, it's better to have a short, sharp period of adjustment, which then means you don't build high inflation into long-term thinking, than it is to have if they were to leave monetary policy too loose for too long, then this gets built into a much longer-term inflationary period. So we're just going to have to see how this plays out. But if it's well managed, inflation should then start to fall, during the course of next year. But it's more prolonged than is comfortable, and it's much more prolonged than the central bankers thought was going to happen. So now I would love to bring our two former winners of the Creative Entrepreneur Award on stage and introduce them to you and ask them to give you an update on what's been happening with them. The first, Jenny, who's going to come up to talk about Drumworks. We haven't seen Jenny for quite a few years, and I myself am really looking forward to hearing what they've done. Mark, who's going to come up afterwards, you've seen more recently, but a huge amount's been going on with what he's been doing, so there's a lot to update you on. So, Jenny, thank you very much.
Thank you. Hi, everyone. I'm Jenny Beer. I'm the Managing Director of Drumworks. We were the first recipients of the Amati Guildhall Entrepreneurs Award back in 2014, so yeah, quite a few years ago now, and obviously a lot has changed in that time. I thought I'd just begin by giving a bit of background information about Drumworks, as I assume quite a lot of you won't have heard of us before or heard me speak before, so I thought it'd be useful just to kind of set the scene a bit. So Drumworks is a social music project. We use drumming as a tool to achieve positive personal and social outcomes for our participants. We primarily work with young people in East London boroughs, particularly targeting young people who stand to benefit most. So obviously, often that's young people at risk of exclusion, those with social, emotional, mental health needs, those at risk of gang involvement, things like that. We do this through we work in depth with young people over a sustained number of years. And we do this through schools partnerships. So at the moment we have 5 schools that we work with on a weekly basis. That'll increase to 7 in September. We've also launched 2 community programmes, one in Walthamstow and one in Newham. And we have 2 progression ensembles for young people that have come up through the schools and community programmes so they can kind of take their skills further. And our top band drumheads, they perform at a semi-professional level. So, for example, last year they played with Kiala Settle at the Royal Variety Performance. They'll be headlining at Grow Hackney's anniversary celebrations in a few weeks' time. They do some quite high-profile gigs. Our approach with the young people is based on creating music together. So we take musical ideas that the young people are interested in and write music with them so that they have pride in the output and they feel ownership of it because it's theirs and they created it. Drumming is a great leveller. Anyone can pick up a drum and play something that sounds half decent within a few minutes. And the fact that we then work with people on a consistent basis for several years obviously allows opportunities for progression, and it also gives people a sense of belonging. A lot of our participants tell us that Drumworks feels like a family, which is particularly important for those who perhaps have quite unsettled home lives and not much consistency in their relationships. I mean, for some young people we work with, their relationship with their DrumWorks tutor is actually longer than with any other adult in their life, so it can be quite profound for them. I'm just going to share one case study with you. We've got all sorts of examples of the impact it's had on young people, but there's one that really stands out. And this was a boy from Barking and Dagenham in one of our schools. When he arrived at school, aged 11, his teachers told us he was involved in fights all the time. He was excluded sort of temporarily on several occasions, spent a lot of time in isolation, was really high risk of permanent exclusion from school, and his academic studies were suffering as a result. When he started working with DrumWorks, he started spending time in the music department in his lunch breaks and in his breaks as well, and that stopped him from getting involved in fights. His concentration improved, his confidence improved, his attention span improved, and then other teachers across the school started seeing these improvements in their subjects as well, not just in music. So by the time he got to year 11, his GCSE year, he hadn't been excluded for a long time. He was a lead learner in music lessons, so he was actually taking a lead role in those classes. He finished school with a good crop of GCSEs and went on to do an apprenticeship in the catering industry, which he's now in the middle of. And both his mum and the teachers at this school have all said that if it wasn't for his involvement in DrumWorks, they don't think he would have got through his school career. He would have been permanently excluded earlier on. So it's obviously made quite an impact on his life. So, yes, 8 years on from when we won the award back in 2014. Back then, we were working with about 400 people just through our schools programme and progression routes. We've now, with the community strand as well, expanded that to about 650 people that we're seeing every week. We have a youth board now. We've grown our administrative team. We're growing our team of freelance music leaders who can go out and deliver the work that we do. Our schools programme has developed as well, so we don't just work in mainstream schools anymore. In 2016, we started working with the Garden School in Hackney, which is provision for young people with autism and severe learning difficulties. Our workshop leaders there developed a completely new way of delivering music activities in that setting, because a lot of the kids are non-verbal and it's very different to working in mainstream schools. And the school have described that as groundbreaking. This year, in September, we'll be starting to work with a pupil referral unit, which I don't know if you're familiar with these, but it's alternative provision for young people who, for whatever reason, can't engage in mainstream education, often because they've been excluded, but sometimes it's to do with their own kind of mental health needs or behavioural needs. So this is another new development for us, and we're hoping, as we did with the Garden School in Hackney, to develop a sort of new way of working in this setting that we can then take on and do in other places as well. Our communities model is a different thing again. So as I said, we've got community projects in Walthamstow and in Newham. And the way these work, we offer sessions for all ages from 3 right up to adults. And anybody can pay to join a class. If anyone wants to have a go at drumming, they're applicable on our website. And then those fees will pay for half of the spaces which we reserve for young people in challenging circumstances who are referred to us through social services or local youth workers and community youth organisations and things. In terms of our organisational development, our turnover has grown from, it was 135,000 back in when we first started, and it's now 210k. There was a bit of a dip in the pandemic, the years affected by that, but we've bounced back pretty quickly, and we're forecasting 210 again this year, which is great. And we have a mixed funding model, about half and half grants and earned income. Sort of find that works quite well for us. We've developed good funding relationships with large grant funders, including Youth Music, the City of London Education Trust Fund, and the Rank Foundation. And we've actually this year just applied to join the Arts Council's national portfolio, which if we get that would be a big chunk of unrestricted funding each year, which will enable us to, it'll be a real step change for the organisation and enable us to kind of plan and deliver our work in a different way. In terms of earned income generation, we've been absolutely flat out doing performances and workshops over the last few months. We were quite worried about that in the pandemic. We weren't sure quite how fast it was going to pick up, but we've been, really busy. We get booked for what feels like every sporting event that happens in London, the marathon, half marathons, 10Ks, cycling events. Thorpe Park actually asked us to play there every day for a month for their Mardi Gras festival, which is happening at the moment. Unfortunately, we couldn't take every single date, but we've done quite a lot of those, and it's been quite fun going there. We've been able to get on the rides, which has been nice. And we've got lots more in the pipeline for the rest of the summer as well. I actually worked out the other day that we're going to reach our income target for performances for the financial year by August, which I didn't see coming. So that's really exciting. We're also working on developing corporate team building because that's a really good earner for us. We were doing quite well with this before the pandemic. We'd built a relationship with the marketing and media company, The Drum, and they were helping us to get bookings in the diaries. We'd had some quite big names booked in, including Coots and Accenture and people like that. That got a bit derailed by the pandemic, so we're just in the process of rebuilding those partnerships now and kind of getting that back on track. And the final update for me, it's really exciting, is that 2 of our team members moved out to the Netherlands in 2020 and are now setting up a Drumworks project over there with our support and guidance and sort of structures in place. And they've got their company established and they're launching in their first partner school in September. So starting to take over the world. That's it from me. Questions or at the end? Or? That's fantastic.
Yeah, what a tremendous update. Thank you so much. We've probably got time for a question if anybody would like to fire one in. Yes.
How are you inspired to...
Sorry, just wait for the microphone 1 second. Thanks.
Thank you. How are you inspired to create Drumworks, first off?
From the beginning? That's a great question. So it actually started in 2007. It was originally part of the Barbican Centre's Creative Learning Programme. And it started off in a school in Bethnal Green with one group of 20 people. And it was attached to a Brazilian samba project. But they quite quickly realised that the Brazilian samba music didn't really have much relevance to the kids. And so the workshop leader started writing musical material with the kids instead and developing their own music, and that really took off. The young people loved it. It got bigger and bigger. Other schools started to want to take part, and that's how it kind of grew. And then it got to the point where it couldn't sit within the Barbican's programme anymore. It was too big, and it made more sense to become independent. So that's what we were doing in 2014 when we did the Creative Entrepreneurs course, was setting it up independently.
Yeah, fantastic. What a great journey. Thank you so much.
Thank you.
Yeah, wonderful. Thanks, Jenny. And finally, for today, I'd like to welcome Mark back onto the stage, who's going to give us an update on the ABC of Opera, which you'll probably remember from the last couple of years when Mark's given us some fantastic presentations. So, welcome, Mark.
It's the ABC, the ABC, the ABC of Opera. Well, good afternoon. And I thought that I should probably, when I walked into this building, either sing a little bit of the Barber of Seville or Sweeney Todd. But I've left that there. This building, one thing is for sure, it's full of history, it's full of stories, it's full of imagination. And I think that's exactly what I wanted to do with ABC of Opera. I went to the Guildhall School of Music as an opera singer, and for 35 years, I know I don't look that old, but I am. I sung at the Met and New York City Opera and various other Royal Opera House, etc. But I had this passion. My mum was crazy, and she kind of believed that children should be exposed to theatre and to the arts from as soon as possible. So 5 years ago, the ABC of Opera was born. ABC, anybody can. But I sat in a meeting with Cardiff Singer of the World, and they turned to me and they said, "What does ABC stand for?" And I'm thinking, I have no idea. And they went, "Well, surely it's like a school, Grange Hill or something like that." And I went, "Or Harry Potter." And I went, "Yes, it's the Academy of..." And they went, "Barmy." And I said, "Composers." And so the Academy of Barmy Composers opened its door. We've now delivered workshops to 15,500 children, and the whole thing has grown. So the whole point is kind of horrible histories meets classical music. And for me, I love the music, I love the stories, but the big statement coming up, I kind of think that some of the education departments and the opera houses have got it a bit wrong. They go out there and they tell the story of Carmen or Magic Flute or Hansel and Gretel. It's usually those three operas. And that's it, it's left. So what we do is tell the story of the composers who wrote those operas. Those composers that had things to overcome. Mozart was autistic, Beethoven was deaf, and so the list goes on. And in 1597, I was looking outside, this building is 10 years old, not the building, the story of the building. 10 years older, they all sat around the table in Florence inside. So let's go through the door of the academy into the hall. That's obviously the elevator pitch. Well, I thought it was funny. So, ABC, a cross-curriculum musical adventure that delivers invaluable life lessons to children through a lively exploration of the lives and music of the world's greatest composers, building character, celebrating difference, and encouraging creativity for our young learners. Cadoxton School in Cardiff, the impact of working with ABC, exploring a journey into the expressive arts, has been huge on pupils' well-being and attitude to learning. We've got children turning up from school who were running away before. The response has been 100% positive. They're all asking, what's more? What's next? We were then given a 4-book deal. Book 1 is out, Baroque, and Book 2 follows Classical. Romantic is meant to have been written, but I'm a bit behind on it. And then Modern. But my dream was always to take the children to the theatre and to, I don't know, to use their imagination to go way beyond what I ever thought of. So here we are inside the academy. We have 4 doors, and each door will take us to a different piece of history, a different adventure, a different set of composers. If we play the video, we can hear what the children think of the project.
That was fun. Excellent. It was really fun to learn about a different story that I've absolutely never heard of before. It was nice to learn about new stuff. I love everything, being excited for every Friday to see Mark.
BBC Opera has been absolutely amazing in just helping the children to come out of themselves.
Out of our comfort zone. Yeah, out of our comfort zone, but in a good way.
Just the quality of what's provided, the resources that are made and the content that's delivered, it's just the all-around package really.
It was very fun.
Right at the beginning, we've got a company coming in, we're going to be spending the next 10 weeks with them, and we're going to be learning about opera. And you physically saw their faces dropped, but it's actually absolutely brought it to life for them.
My favourite thing was putting together the songs, getting to perform in front of the adults and seeing their reaction. Yeah. All of the props and learning about the story. I enjoyed when we all had to sing the songs and all the little games and stuff. Mostly the painting, the acting, I like doing the acting. I just loved acting how it was funny, especially some of the words I said on there as well. So you can stop composing music and do something useful, you bunch of bombing.
The majority of the children are not natural performers, but sort of as the weeks have gone on, we've seen a huge increase. The fact that the children will just get up and open their mouths and sing, and that is just a huge step forward for these children.
Because I got out of my comfort zone a bit, singing in front of everyone, it was just really enjoyable.
Especially for delivering expressive arts, and if you're somebody who maybe isn't too confident about that, it was a really wonderful experience.
Since I've been a toddler, I've always wanted to perform, be a dancer and everything, so this is like one big step for me now. Yeah. I did enjoy history before that, but this is sort of like a new window of history. Yeah, it's a new door that's been opened. Yeah.
a certain number of children who perhaps initially didn't think performing was them, but when we built into the characters, we read the story and they got a bit more invested. That's when we saw those children kind of really come out of their shells, which was lovely.
They've performed, they've done art, they've done dancing, they did sign language at one point, and just to see the way they've developed is amazing.
I was crying on first day, but I feel amazing after doing it.
The little lad at the end came up and just took the cover off the artwork they've done. And that's one little boy who normally wouldn't speak. He's almost mute and would never ever stand up in front of a crowd. So just to see him there is just fantastic.
I want to carry it on because of how fun it's been. I didn't think I'd enjoy it that much. So now we're actually here and now we've actually done it. I really enjoyed it.
Brought it together on the day and they've actually performed. Couldn't be more proud of them and I couldn't ask for more.
So with that school, it gives me a bit of a lump in my throat and goose pimples, is that we were brought into that school because every member of the class in year 6 of last year before high school was underachieving. We went in for 10 weeks and they've all passed all their exams, they've all got confidence, they're standing up, they're performing, and the teachers are now taking on the resources, because during lockdown, we were obviously hit terribly, and I went on the phone to Paul and I said, I've got a great idea, but I've got no money. Nothing new in that with an artist, is there? And I said, resources to go into school to sit alongside our workshops. So we're now in 38 schools that we teach the whole of the curriculum through the Academy of Barmy Composers. So thank you for believing and sending some money our way to make it happen. We've got here the National Children's Orchestra are looking to do a prom with us next year. We're in the middle of discussions where horrible history meets classical music, riotously unstuffy, anybody can. A 5-star from us. So 5 years on, what have we done? 300 school workshops and going up daily. 38 schools are now signed up and delivering the whole curriculum. 2 books written, Baroque and Classical, 2 more to come out. Last week we had our first proposal, which is, the figures are quite daunting but very exciting, for a TV show. BBC Proms, and a stage is set to bring the Academy of Barmy Composers 100% back. They're going to stop decomposing and start recomposing. 100% feedback from the school, want more. Collaboration, and we've just signed up with the University of Wales. They've invested money in the company, and over the next 2 years, we'll have accreditation and we'll be on the curriculum for Wales, as well as Open University having the same discussions. Teaching resources are now available in English for the English curriculum, written by Open University, as well as available for the whole of the Welsh curriculum. Audiobooks are out, read by Sir Bryn Terfel. Immersive Opera House, and this is exciting, going to be on the campus with the University of Wales in Carmarthen and Swansea, designed by us and Samson. Appointment of 3 new directors, David Jackson, OB, who is the artistic director for Cardiff Singer of the World. Mario Dubois, up until a month ago, was the commissioning editor for CBBC. And Steve George at the back, financial director for, and the ideas man for many of the banks and things in the city. Terry Deary, Horrible Histories, has now come on as our advisor. 2022 finalists in the Music and Drama Education Awards, discussion, collaboration with the National Children's Orchestra, and a prom, and a stage show devised with full orchestra, the music services around the United Kingdom, to bring the Academy alive. Can we see a tiny bit of that? I know time may be pressing.
Let me enlighten you. Opera, whatever music can convey, we call it opera. There's always magic in the air, so just listen to the music and you'll find out of the blue that the ABC of opera for me. Where did it all begin? Stories and the stories of the opera. Everyone loves to sing. It's as natural as breathing in the air. The Italians took the tales, the Greeks not long ago. They sprinkled on some magic to make the story grow. This little book will help you to see where it began. Our friends at the Academy said everybody can.
Queen of the Night at the Royal Opera House. You've got to get the best, haven't you?
Handel, Donald, Handel. Oh, this English plays with my brain, you know. Oh. I'm not a happy Handel. This really is a scandal. Donald's not a Handel. I am the only Handel.
I am Claudio Monteverdi, and I'm part of this musical journey.
Don't worry, it's not a real horse.
Although Perry invented the opera, I'm the first to make opera popular.
Stop below, taught me music. But I'm the greatest, they say. I left over my master and blew him away. I got a pimple on my nose, and the wart lives on my chin. It's embarrassed me for all these years. I submitted this sin.
All the music I invented, it was quite unprecedented. I wrote things they said I shouldn't, but that's all the
Stick them all together and we're in Baroque. Stick them all together and we're in Baroque.
And you are the chosen ones who can save our music stories at the Academy of Barney Composers.
Give me an A! A! Give me a B! B! Give me a C, a C, a C, a C, a C. Give me a C, it's the ABC. What's the ABC? What's the ABC? Oh,
So yes, all the Academy, from Professor Perry, the inventor, Too Hot to Handle, Perfect Purcell, Maestromonte, Windy Wolfgang, Tortellini, Rossini, etc. You can see some of the things that people say, particularly in the special schools where it's amazing the impact. There's suddenly, you know, in the video, a child who's an elected mute suddenly comes up to me and says, "Mark, I want to sing. I want to sing a line in the show." Thank you to Amati. These are some of our partners that have helped us to get to this point. And I start lecturing on the PGC course with University of Wales from September. And we've got a set of teachers that are now working with ABC to take it into as many classrooms as possible. So creativity can sit at the heart of every classroom. Thank you so much for this afternoon, for letting us share our story. I think that's in most languages. As they say at the Academy, anybody can, but more than anything, diolch yn fawr. Thank you very much.
Wow. Well, thank you, Mark. That was truly superb. So, yeah, thank you for such a fantastic presentation as well. I was thinking there, actually, we should probably give everyone here formal notice that next year's AGM is going to be purely sung. And so can we have all questions in the form of an aria? And we might call it the VCT of opera. But anyway, we might need Mark to do a workshop in the morning just to kind of get us in the mood. But anyway, thank you. That was, when we started the Creative Entrepreneurs Award, you know, we had no idea what we were going to find and how these things were going to go. But it's genuinely really moving and fantastic to see two such thriving companies that have been part of our award. So thank you both very much for coming back in. Really is a delight to hear what you've both been doing. So with that, we come to the end of today's proceedings. Thank you so much for staying with us. We're going to have some drinks and canapes out here on the terrace. So please do join us, and we'll look forward to chatting to you. Thanks very much indeed.